Right, good morning, ladies and gentlemen. Welcome to this, the 6th meeting in 2014 of the Economy, Energy and Tourism Committee. I'd like to welcome our witnesses, who I'll introduce in a moment. And can I remind everyone, please, to turn off, or at least turn to silent, all mobile phones and other electronic devices so they don't interfere with the committee's work. We have apologies this morning from Dennis Robertson, who unfortunately is unwell, and we're joined by Joan McAlpin as a substitute. Now, item 1, declaration of interest. I'd like to welcome Richard Baker as a new member of the committee and pay tribute to Hanzala Malik, who has departed for pastures new, and thank Hanzala for his contribution to the committee's work over the previous months and wish him well in his new position. Richard, can I ask you, please, if you would declare any relevant interest to the committee's work?
Convener, I think I should declare an interest as a member of the Trade Union Unite.
Okay. Thank you very much. Item 2 on the agenda is a continuation of our inquiry into Scotland's economic future post-2014. I'd like to welcome the first panel of witnesses. We are joined from the left by Dr. Angus Armstrong, who's from the National Institute of Economic and Social Research and a Fellow of the ESRC Future of the UK and Scotland programme. We're joined also by a very familiar face, Professor Joe Armstrong, who is an independent economist and researcher at the Centre for Public Policies for the Regions, University of Glasgow, and by Paul Johnson, Director for the Institute of Fiscal Studies. Welcome to you all. As I mentioned previously to members privately, we are a little bit short on time this morning. We're hoping to get through the first panel by about 10:30. So I'd ask members if they would be concise and to the point in their questioning, and if we could have as concise answers as are as possible, that would be very, very helpful. I would ask members if they would to direct their questions to a particular member of the panel, and if you would like to respond to a question that's been addressed to somebody else and come in with a comment, just catch my eye and I will bring you in as time permits. Right, I can maybe just start off, if I can, with the first question to yourself. We've got two Armstrongs, Dr. Angus Armstrong, I think, but I use first names, otherwise I get very confused. Dr. Angus Armstrong, obviously the issue of currency options has become a very important one in terms of the debate. I think the First Minister said last week it was in the overwhelming interest of the rest of the UK to enter a currency union with Scotland. Is that a fair analysis of the position? And is the decision taken by George Osborne and his colleagues to rule out a currency union a rational decision?
Thank you very much and good morning, members. You're completely correct to say that the currency issue is at the centre of the debate, and in my opinion it will remain so all the way through this period. It is actually central to many of the economic issues. In terms of what has developed in the last couple of weeks, we have to be very careful with terms here. What was proposed in the White Paper was a particular form of currency union, a formal currency union, which is not just sharing the currency, it's about sharing the infrastructure, in particular the central bank. And behind the central bank, of course, is the taxpayer. So in this case, it would be the taxpayer of the rest of the United Kingdom. And so the Chancellor of the Exchequer, his response that he did not believe this would be in the United Kingdom's interest, that actually accords with our research, which we've been publishing for since last, I think, September, suggesting that a formal currency union between an independent country and the rest of the United Kingdom would be very difficult to strike, and actually would be in neither party's interest. So it's actually quite a different view to what is often heard, that it would be in independent Scotland's interest but not in the United Kingdom's interest. Actually, we don't think it would be in either party's interest, because the restrictions that would be imposed would actually be very considerable indeed. In terms of the First Minister's statements, is this really going to be in the interest of the rest of the United Kingdom? Well, the benefit is that there would be no costs for exchanging currencies for cross-border trade. That's absolutely true. The downsides are that you would essentially be providing a form of insurance for a country which has already declared it wants to be independent, which opens all sorts of moral hazard issues. It means that this country, because it is now a sovereign country, can withdraw from the Union at any time. And so to put the restrictions on to make that work, we think would just be too onerous.
Just coming back to my question,
Yeah.
The decision from George Osborne and his colleagues is a rational decision.
But based on our analysis, we think it's entirely rational.
Okay, thank you. I'm sure other members will want to come in and follow up this question. I want to move on and ask Mr Johnson a question, and perhaps Joe Armstrong could come in response to this as well. I read with great interest the analysis you published yesterday, Mr Johnson, of the financial position an independent Scotland could be in the event of a yes vote. Would it be fair to conclude from that that people who think that voting yes to independence is an escape from austerity are mistaken?
The UK as a whole remains with very, very high levels of borrowing at the moment, and that will the current UK government's plans are to reduce that towards zero by 2018. The Scottish fiscal situation, if it were independent, wouldn't be terribly different from that of the UK as a whole. Now, there's no getting around the fact that at some point and over some period, that some additional fiscal consolidation will be required. Now, the current UK government wants to get to budget balance by 2018. The opposition Labour Party wants to get to something, suggested it wants something slightly different, which is what it calls current budget balance, which would require something like 25 billion less of spending cuts or tax increases. So there is clearly, within the UK debate, some debate about how fast austerity needs to be introduced over the next several years. But were Scotland to become independent in 2016, there would remain a significant deficit, which would need to be addressed at some point. So there's no getting away from that. I think the biggest uncertainty probably is about the amount of debt that an independent Scotland would take on. If it were to take on a debt at, for example, shared on a per capita basis, which would be above 70% of its debt, 70% of its national income, from 2016, that would be a considerable constraint and would certainly require continued movement towards budget balance over the relatively short period. If it were to take on a significantly smaller amount of debt than that, then it would actually have more fiscal room for manoeuvre. So I think there's a big uncertainty about the level of debt that it would take on. The level of annual deficit that it would take on is less uncertain and would require dealing with at some point.
And do you have a view on this question of debt? If an independent Scotland could walk away from a share of debt, in however that might happen in practice, would that be positive or negative? Because we've heard some suggestion it would be potentially very negative in terms of the international markets.
I think that would depend on how it happened. I mean, in one sense, it would clearly be very positive. For an independent country to start off with no debt is rather a good place to be relative to starting off with debt at around 70% of national income, and particularly for a country the size of Scotland and one new to the international market. So I think there will be significant benefits to walking away with no debt. How that came about, I suspect, would be the thing which would determine whether there were any additional negative consequences in terms of credibility.
Armstrong, do you want to come in on this?
Good morning, thank you. Yes, I would agree with Paul. Having no debt to start with is always going to be a better position than taking on a significant amount of debt. And the way the negotiation went about could suggest that potentially Scotland could be seen to be not only being sensible but having negotiated a very good deal. That would then free up the opportunity to raise more debt, more borrowings to potentially invest in infrastructure. The reality that's facing Scotland, whatever happens in September, as I said in my submission, is that we have got a big challenge in our hands, Scotland and the UK. We've got to improve our productivity position markedly from where we are at the moment if we want to have sustainable economic growth and high and rising real earnings. If you just look at the data that the Scottish Government produced, in the 10 years we've had 10 years of plenty, we've managed to reduce our gap between us being at the top of the third quartile of the OECD countries The gap's reduced between us and the bottom of the first quartile by 10 percentage points. That's in times of plenty. So to improve that and get us to the top quartile means we have to do something quite remarkable. And what we don't have at the moment from either side is any narrative around how actually that's going to be delivered. But certainly having no debt as your opening start, that would be a good position to be in. You then don't need to go to the markets as quickly to be able to borrow. You therefore you can take time to build up a track record and get a credit rating that gives you a decent interest rate.
Dr. Angus Armstrong will come in with a comment, and I'll go to Marco Biaggi for a quick supplementary, and then to Chick Brodie. So,
Thank you. I strongly disagree. I think that the notion of not accepting what most people would consider to be a reasonable and fair share of debt. Now, that number clearly has to be negotiated and decided. I don't know what that number is. It has been discussed, and the First Minister has discussed, that a population share, he's discussed this on TV, seems to be reasonable. To walk away from that, there's a couple of interesting things. First of all, the precedent this would set for the rest of Europe would be extraordinary. It means any part can actually unilaterally have a referendum for independence and have no debt. There's lots of places in Europe that would like to do this, and so I think people just have to think about the broader consequence of that. That's the first point. The second point is borrowing costs. You know, if I'm going to lend you money for 10 years as an international investor, I would like to know there's a good chance of being repaid. This is not the great precedent. And the final thing is how it would actually play out in practice. This would start a very difficult set of negotiations which require goodwill on both sides. That's why a reasonable number has to be negotiated. For example, the oil contracts have to be transferred. The debt is collected in the tax revenues are collected in London and passed to Scotland. All of these things people want to go smoothly, and so I think it's important that a very reasonable agreement is struck, and walking away from it or reneging, I think, would be irresponsible.
Biaggi, briefly, please.
Yes, very briefly. Mr Johnson, you referred to the level of debt to GDP that an independent Scotland would inherit if we got a population share of the UK debt. Can you just tell me, is that a higher or lower debt to GDP ratio than for the UK as a whole?
If you're including North Sea oil in the GDP, then it will be a lower proportion.
And if you excluded profits, dividends and interest extracted from the UK, it would then be higher.
Thank you. Talk about narrative. I mean, I go just to look at the relative performances on any meaningful measure, be that trade deficit, fiscal deficit, debt per head as a percentage of GDP, the liabilities of the UK as a whole. Scotland's performance, as has been indicated, has outstripped that of the rest of the UK. I wonder if I might ask Mr Johnson, reference your report. The Standard & Poor's report described Scotland as benefiting from investment-grade sovereign credit characterised by its wealthy economy, roughly the size of New Zealand's, high-quality human capital, flexible product, labour markets and transparent institutions. On the basis of all that, how would you describe the strength of Scotland's economy, and what do you think would happen to it if it remained within the UK?
Well, I don't disagree with any of that. I mean, Scotland clearly is a rich economy. I mean, within the UK, as you know, it's one of the richest regions, and no doubt it will continue to be successful inside or outside of the UK. I think I'm not in a position to be able to say in any sense whether it would do better economically inside or outside of the UK, but I think
But the portents are there in terms of performance, particularly over the last 30 years.
The statement that this is a rich and successful economy is one I would entirely agree with.
Thank you. I wonder if I may ask very briefly, Professor Armstrong, what credibility do you give to the OBR's projections and their seemingly unending fluctuations?
Or anything in particular?
No, just in general.
Generally? Okay. sort of wide-ranging conversation that I couldn't give you trapped in reverse on how their forecasting record goes. I think you probably want me to say something about oil price forecasts, since that's the most contentious element of how they've performed. The oil price forecasts in the OBR are the only official set of oil price forecasts that we have to date. And I think my understanding is that OBR take their evidence from the Department of Energy. And the Department of Energy's track record is, on the record, is they're consistently optimistic, as are Oil and Gas UK on output. So whilst we have seen oil price forecasts, certainly since OBR started coming down quite markedly, I think they started about 11 billion and have come down to about 5 billion on a like-for-like basis. So they have dramatically fallen since OBR came into being. They use the best evidence that's available. And I think what it tells us is that to forecast oil prices and then to forecast output from the North Sea and then to forecast tax revenues accruing as a consequence is an extremely difficult business, even for those who are the experts in the industry.
But if I may then come back to the IFS report on the basis of that difficulty that we appear to have with the OBR's predictions. The projections, Mr Johnson, as to what's going to happen, don't account for the policy decisions an independent Scotland might take. Rather, the 50-year forecasts that we've seen are based on unchanged policy. Do you not accept that an independent Scotland would make policy decisions that would build on the strength of the economy, that would change the picture that has been presented?
Of course. So if we're looking at the long-term forecast, what we tried to do there was essentially replicate for Scotland what the OBR does for the UK as a whole. I don't think anyone thinks that what this is saying is painting a picture of what the world will actually look like in 50 years' time. What it's doing is setting out the constraints that are likely to face the UK and Scotland, and actually the picture isn't terribly different between the UK as a whole and Scotland independently. And those constraints are essentially driven by two things. One is demographic change, which will see all Western developed economies ageing significantly over this period, which will put additional strain on the public finances. Actually, we're seeing that just over this decade. There's a remarkable, across the UK, increase in the number of older people. There's a 2 million or 20% increase just in this decade that we're in at the moment in the number of people over the age of 65, and that's something that has been known about for a while, but it is something that is hitting the public finances as we speak. So spending on pensions is rising quite fast at the moment, and the pressure on the health service and on social care is also increasing as a result of that. So if you look forward, you can see that that trend will continue, and the question is exactly as you describe, how to deal with it. No one's suggesting that it will be ignored, but it's making clear that something needs to be done. So that's one part of what those kinds of things are doing. The other thing that is important to look at going forward is also to look at the tax base and where how the tax base will develop. Now, across the UK as a whole, there are some important concerns. Corporation tax, for example, may continue on a downward trend over the long term because of difficulties about raising it from multinational companies, though that has happened a lot less quickly than people were thinking it might happen 20 years ago. Tax on petrol seems to be extremely difficult for governments even to keep it up in line with other prices, so one might be concerned about that. But equally, if we're to meet or come anywhere near to meeting our climate change targets, there will be no petrol cars in 30 years' time, so there won't be any tax on petrol. That's a very large amount of money to lose. In the UK, but more specifically in the Scottish context, there's also, of course, uncertainty about revenues from oil. So that's the second part of it, is to say there are some concerns about the tax base as well. And so the issue, exactly as you describe, is, well, we know that now, how are we going to plan for the future? Again, whether it's an independent Scotland or the UK as a whole, these are significant challenges to face, which we hope and to some extent believe will actually be addressed.
Given the strength of the Standard & Poor's report, the acceptance that the forecasts would obviously be affected by Scotland making its own independent decisions. I wonder if I may ask one last question, Convener. If I read the Sperry report, NIESR report, comments by the Wall Street Journal in terms of the strength of the UK vis-à-vis, as I mentioned, the rest of the UK, the study is based essentially on UK stats and trends relating to Scotland within the UK. Do you see anything within the UK today that suggests these trends would change if Scotland doesn't take issues into its own hands? Scotland would suffer a decline if it stayed within the UK, wouldn't it?
Suffer decline?
Well, in relative terms, in terms of the way that the rest of the UK economy is going, if Scotland were within the rest of the UK, then we would not have the opportunity to capitalise on the, obviously, the performance that we've had in recent years.
I really wouldn't like to speculate on how the Scottish economy might develop, whether it's inside or outside of the UK.
Okay. Thank you.
Thank you. Okay, Margaret McDougall.
Convener, and good morning, panel. Just to discuss currency a little more. I mean, we've heard the statement from the Chancellor of the Exchequer, but we've yet to hear an announcement from the Yes campaign on their preferred Plan B. In your opinion, what would be the best option for an independent Scotland to use as a currency? Professor Joe Armstrong.
Certainly the currency expert is sitting on the right-hand side, but if I'm being asked for my view, I think it's a very difficult one. I mean, there are pros and cons for all the various options, and again, it's about how would you manage the uncertainties arising from each of the alternatives. So it does depend on the nature of the negotiation. It does depend on the willingness of business to take some of the risks that would be arising from being outside of sterling. So again, for me, if I'm truly independent and I want full access to all the levers of power, I would want to try and make my own currency work, but has got lots and lots of risks associated with it. But it allows me to have absolutely full control of the fiscal levers, which is what an independent country would want.
Dr. Armstrong.
I think that Scotland gains tremendously from being part of a formal monetary union. I think that's why, with independence, the Scottish Government is so in favour of continuing a formal monetary union. Now the issue becomes, since that's been ruled out, what would be in independent Scotland's best interests. And based on the aspiration pointed out in the White Paper to build a Scotland which reflects the values, I think it says values and aspirations of the Scottish people, then I think you want to have something which allows you policy levers to be able to do that. And there is, in my view, only one option which allows you that full range, and that would be your own currency.
If I could just continue.
Don't.
What would be the effects of transaction costs then to Scotland's businesses if it was a separate and different currency? You know, if it had its own currency. Yeah.
So the impact at the moment, there are obviously no transactions costs to doing business, and there would be a transactions cost, so that would be a loss on Scottish businesses from having its own currency. The interesting question is how much, and this is a very contested area in economics. It's quite polarised, the debate. So I'm just going to report some of the findings that people have. It's tricky because they always have to run a scenario of what if you had your own currency. The what if is kind of key to this. And so one broad way to do it is to look at those countries in Europe which did not join the Eurozone but are members of the European Union or the European Economic Area and say, how did they fare compared to the ones that tied their currency even before the crisis period. So this is not a crisis issue, right? So between 2000 and 2010, how did the countries in the Eurozone perform versus those such as Switzerland, Norway, Sweden, outside of the Eurozone? How did they perform? And actually, it's pretty hard to show that the countries outside of the Eurozone performed worse in terms of their export performance. But even that's not quite the right question. What we're asking here is, what would it be like to break a link rather than go to a link? The other ones go to a link. So break a link is the real issue. And we've got one nice example, and that was Ireland in 1979, which of course was linked to sterling, and then joined the euro, so the link was broken. And looking at the trend of Irish exports to the rest of the United Kingdom, there's a published journal on this, in a referee journal. It's very hard to discern a break in the trend in exports. Now, this is not to say there's no effect, but it looks like the effect might be fairly small based on much of the evidence. Against that, there is one person whose name will come to me, who's written quite extensively on currency arrangements, who takes odds with all of those studies. So I think that would be unfortunately, there are differences of views, but for me, the best way is just to look at the countries rather than get too bogged down in the methodology. Just look at the countries, how those ones are performed inside a union and outside of a fixed currency, and it doesn't look like there's been a great deal of difference. And can I also just say, with your own currency, that doesn't mean to say it fluctuates all the time. I think it would be very important for Scotland to look to have a very close peg to sterling. So it's not as though this thing's going to be fluctuating or necessarily has to fluctuate widely.
But we've heard that a statement from the Yes campaign that there would be, is it 500 million costs of transaction costs for the rest of the UK if Scotland moved and was independent. So are you saying that that isn't reversed? There isn't costs then for Scotland?
Well, no. What I'm saying is, first of all, there would be costs. So let's not. The question is, how big are they? Because Scotland exports a much bigger share to the rest of the UK than the rest of the UK exports to Scotland, the cost will be much more on Scotland's side. Where the 500 million comes from, I haven't actually seen the methodology of how they've calculated that.
Right. Thank you. Professor Armstrong, did you want to come in?
Yeah, just it was more a slight aside, but we don't hear anything about the fact that there are parts of the country already trading in international currencies, so there wouldn't be any additional transactions costs. So, for example, oil and gas is traded in dollars, and probably like the drinks industry is probably traded in international currencies too. So it isn't all additional costs to all parts of the Scottish economy. And like Angus is saying, you don't have to worry about fluctuations. There's a possibility, some benefit from having your own currency. You can depreciate it and allow you to actually be more competitive. So,
right. Thank you.
Thank you. Alison Johnson.
I would direct this first question to Professor Armstrong and Dr Armstrong, if I may. I think my colleague Margaret McDougall was trying to ascertain what would be the best currency option for an independent Scotland. What would be the best currency option were Scotland to become independent for the rest of the UK?
I'm definitely going to cede to the currency expert on my right on that one.
So what would be the best currency option for Scotland, but for the rest of the UK? I mean, the UK is going to keep with its currency.
If Scotland becomes independent,
yeah,
what currency option would that independent Scotland take that would best fit with the interests of the rest of the UK?
So the best interests of the UK would be to have a strong Scottish economy, one that's stable and one that doesn't actually have any chance of imposing costs on itself. And I think that the best option that satisfies those criteria would be for Scotland to have its own currency and for it to be pegged against sterling.
Okay.
On Joe's point, having that flexibility for when something unforeseen happens, I totally agree, is a plus. But what you want to minimise is just noise and volatility. But you want to have some flexibility. So that's, in my view, what would be the rest of the UK's best interests for Scotland to choose.
Okay, thank you very much. If I can go on to a different subject, that of taxation. and the possibilities that autonomy would bring to an independent Scotland. The IFS have noted in a report that the Scottish Parliament, I think with under devolved powers, has eschewed more fundamental reform of the taxes that it could reform. Just wondered, perhaps, Mr Johnston and Professor Armstrong, why you think that is the case and what opportunities independence would give Scotland to improve upon the current UK taxation system.
Well, we clearly start from a fairly suboptimal tax system, which could be made more efficient in a number of ways in the UK and in Scotland. So, I mean, there are one or two changes that have been made in Scotland which have improved elements of the tax system. So the proposed change, I'm not sure if it's proposed or implemented now, to stamp duty, for example, is an improvement on the rather curious structure that we have across the rest of the UK, where you have this slab structure and the amount you pay can go up by thousands as you pay an extra £1 for a house. So there are clearly some changes there. On the other hand, there's clearly a need to reform council tax, which hasn't happened in Scotland, as I understand, could have done. I think your kind of fundamental question, though, is I think there are two fundamental questions here. One is about what might a reformed tax system look like, and how might an optimal tax system in Scotland look different from one in the UK. So to that first question, we could talk about an awful lot of things that might change, but certainly reforms, for example, to the VAT base, reforms to the taxation of housing are long overdue. You could improve the efficiency of the direct tax system by bringing income tax and national insurance together. You could certainly improve the way in which the savings tax system works. There's a whole series of things there that you could do, and I'm happy to talk about any of those individually. Why haven't those things changed? Because I think often they involve winners. Change often involves winners and losers. Politicians, as you all know better than I, find that difficult. Find that difficult to do, even if the long-run impacts are positive for the economy, and indeed are overall more equitable. If even a small number of people are worse off as a result of change, that makes change difficult to achieve. Now, whether that will be easier in an independent Scotland, I don't know. I mean, I guess at the point of change, one has lots of opportunities which one doesn't have in the usual run of things. I think the second question really is, would independence change what the optimal tax system looks like? And I think there are a couple of things here which where it might. I mean, an independent Scotland would be a small country in competition with a larger neighbour right next door. In theory, the optimal rates of a number of taxes would be lower. If the UK splits and starts competing with each other, then in a sense tax competition could drive the optimal tax rates lower in each side of the border. And there's been debate in Scotland, I know, about potential for reducing corporation tax in order precisely to take advantage of that kind of tax competition. So you might expect something of that kind to occur. I mentioned taxation of petrol earlier. Scottish roads are significantly less congested than roads in England on average. I know that's not true everywhere. The result is the optimal level of tax on petrol is probably lower in Scotland than it is in England. So there could be some changes of that kind. And then, of course, independent. I mean, we talked about the costs of potentially different currencies, but having VAT based in Scotland and VAT based in England would be another thing which would potentially increase the costs of doing business between the two. The extent to which tax rates and structures diverge, the more that they diverge, the more difficult doing business between the two would be likely to become. So actually, the appropriate structure of taxation in Scotland and in the rest of the UK will be to some extent dependent on one another.
Okay, thank you. Professor Armstrong, do you have a view? I mean, do you think it's the case that Scotland hasn't been as bold as it could be with the powers it already has because it doesn't have all the powers and it can sort of continue to let others take those decisions on its behalf? Do you think we will see a real radical change?
It's not a leading question at all. I think it's had limited tax powers, so clearly what it's been able to do has been limited by what the powers it's got. It has aspirations, or the current white paper that we've got suggests there's aspirations to reduce corporation tax and to reduce air passenger duties, both of which clearly are targeted at trying to create a more attractive environment for either with inward investment or to improve connections internationally to help increase Scotland's export potential. The challenge that Scotland faces at the moment is in any tax changes it makes, and if it's about reducing taxes to increase competitiveness, any tax changes it makes, it then needs to find ways of filling that gap, certainly in the short term, and I don't know quite how long that short-term period is, but certainly in the short term it needs to find some other routes to fill that gap, to fund the current and anticipated spending plans. And it's not clear to me exactly how that's going to be done. We can hear the opportunities that are out there, but to make those opportunities live on day one when we've got a fiscal deficit and we've potentially got limits on how much additional borrowing we can make suggests to me we're either increasing taxes somewhere else or we're cutting spending. The ideal time to make radical changes to your tax system is when you've got money to be able to allow difficult things to be done and brought in a transition or a phased basis. We don't have that flexibility at the moment. So what's interesting is what taxes we have seen being deployed within in Scotland. We've had council tax being frozen, and we've seen non-domestic rates rising. Non-domestic rates for larger businesses, small businesses have had tax breaks or holidays. So it's difficult to see how the rhetoric behind kind of council non-domestic rates, which is a business tax, the reality is it's actually risen rather than fallen, but the corporation tax aspirations appear to be for them to fall. So I think there's a lot of work would need to be done to understand how the appropriate mix could be, given the theory, and what is possible given the actual financial constraints that we have and will continue to have for some foreseeable time.
Okay, thank you. Thank you, Convener.
Okay, supplementary from Joan McCullough.
Yes, just a very quick supplementary to Alison Johnson's first question, Dr Armstrong, when she asked you what the best currency option of an independent Scotland would be for the rest of the UK. And after some thought, you said that you thought an independent currency pegged to sterling would be the best option. The Economic Affairs Committee of the House of Lords looked at this last year, and in its report in March 2012, they said an independent currency pegged to sterling would mean that a Scottish central bank would need to follow closely the Bank of England policy, thus undermining the reason for introducing the new currency in the first place. Would you care to reflect on that?
Sure. So I probably should declare an interest that I was the Special Advisor for the House of Lords report. My view on it, so that was, of course, not my view, that whole report, but my view on that statement, that I haven't been elevated yet. My view on that statement is the reason why you would peg it is because you would like to have this exchange rate stability. It would mean that you would give up a degree of monetary independence, but when the rainy day happens, the shock happens, and, the 70s it was the energy crisis, in the 80s you had very high unemployment, in the 90s the financial crisis, then you've got your degree of flexibility. So it's not that you want to be moving this all the time and necessarily setting your own domestic interest rates, but occasionally when something really bad happens, you need to have a safety valve to be able to make the adjustments. That's why I've made that statement.
But even your best case scenario for the UK does impose certain limitations on Scotland.
My best case scenario.
Well, this is this independent currency pegged to sterling.
Absolutely. Well, it depends it imposes some limitations, but I would argue those limitations are the optimal choice of a trade-off. So you have a trade-off here between things like exchange rate stability and the degree of independence of monetary policy that you have. There's a trade-off there. And what I'm saying is neither extreme, i.e. allowing a lot of volatility in the exchange rate but having total independence, or having no independence but absolutely no flexibility, neither of those two extremes probably makes sense. However, I do accept that for a very small open economy, and that's not supposed to be pejorative, that's supposed to be a genuine reflection of the size of the trade, the importance of trade to Scotland, is it's probably much closer towards having stability of the exchange rate than anything else.
Okay. And how much control, just one very quickly, if you don't mind, Convener, how much control does Scotland have of monetary policy at the moment?
Well, monetary policy is not decided on a regional basis. It's a monetary policy committee made up of experts. Well, you know the answer to this. There's no regional representation on the monetary policy committee.
Thank you.
But there are regional agents around the country who are actually asked on a monthly basis by the Bank of England about what's happening on a regional basis.
Very brief. Just following on the Alison, and it will be one. Coming back to the Standard & Poor's report, which says the Scottish economy is rich and relatively diversified, it then goes on to say Scottish wealth levels are comparable to that, and of the countries it mentions Germany. And Scotland would qualify for our highest economic assessment. Based on looking at this through the frame of reference of the rest of the UK, we get drawn in always to looking through the Scottish frame of reference. And the point that you made, Dr Armstrong, to Alison Johnson, that what the rest of the UK needs is a strong Scottish economy, which is verified by the Standard & Poor's report. Doesn't that not mean that the comment by the Chancellor of the Exchequer that he would not allow Scotland to share the sterling is a piece of nonsense, isn't it? And sabre-rattling and scaremongering.
So I think I answered that in my address. The reasons why, the reasons why it would not, the formal currency union that's been, the way it's been laid out, is because effectively you'd be providing a degree of insurance for a country that could be bailed out, which would mean you'd want to put some restrictions on it. The country that you're forming a monetary union, of course, because it becomes a sovereign state, will be able to pull out any time, which would mean you'd want to put even more restrictions on, because the time you'd want to pull out, presumably, would be the time it's difficult for you. And so I don't think it's nonsense. I think it's actually, I'm afraid, I think it's a reality. And as regard to the S&P report, I haven't read it too many times and don't have it in front of me, but they do, I think, caveat that a big deal is going to be what's decided about the on the currency option. The currency option, as we've tried to stress in all of our research, depends very heavily on what is agreed on the debt front. If you have no debt, yes, then it's a totally different story. But assuming that a fair share of debt is agreed, then it becomes difficult, the formal monetary union.
Well, we have a fiscal commission coming in the next panel after yourselves, so we can ask them about that. Right, brief supplementary from Margaret McDougall.
I wanted to ask Paul Johnson a question on the taxation. You were saying, you know, if there was a separate taxation system in an independent Scotland, would that be additional costs then for particularly small businesses where they're working with external businesses, and you know, so it's the implication of additional costs and bureaucracy, which would be very difficult for small businesses to deal with?
Well, I don't think one should overstate the scale, but I don't think there's any getting away from the fact that doing business across borders, particularly with different VAT systems, does impose additional costs and complexity. Now, clearly, you know, there's plenty of business across borders, and that works perfectly well. And I think for most businesses that will be something that they could cope with. But that, you know, creating borders and creating different tax systems increases costs.
John Armstrong, do you want to come in?
Yeah, I just wanted to reflect the fact that the Scotland Act is bringing in different tax powers, and so companies who are operating cross-border are going to have to deal with different income tax rates for a start at the moment.
Okay. Angus Armstrong?
Yeah. Can I just say on the tax front, I personally think that both governments could be a lot bolder on tax reform, and I take Paul's point. The trouble is you've got winners and losers, and you know it's very difficult. I also think that it would be very important, I think it is going to be very important for Scotland, whatever the outcome, to have more tax powers. I think that this can be satisfactorily achieved for both sides of the border. The difficulty is the taxing resources which are highly mobile, and so it's a difficult one to do. But I think that it can certainly be beneficial for both sides, and that goes to my point earlier on to Ms Johnson about having a strong Scotland, about it being in the interest. And I think more tax powers is part of that.
Okay. Can I ask one supplementary on tax, and we need to move on. I'll then bring in Christian Allard. But Mr. Johnson, you were talking earlier about the ambition to have a simpler tax system. We know the UK tax code is very complex. It's built up over a long period. There are lots of vested interests which have secured concessions. Given that's the case, why does it say in the white paper, in your opinion, that the entire UK tax code would then be automatically adopted by an independent Scotland? Surely that's a great missed opportunity.
Well, on day one, you need a tax code. And to write one from scratch would be a heck of a business.
But it would not be a lot simpler to make changes before you bring it in, rather than just adopt what we've currently got and then try and make the changes?
Well, you could make some changes, but I think it would be pretty difficult to make wholesale changes or to start completely from scratch. Now, you might want to bring it in and say, well, we're going to have a big reform a few years down the road. But I would have thought in order to get the transition, you're going to want to start with something that was relatively familiar. Presumably, over time, these things would diverge. Now, I think the real question is, in a sense, would the sort of political and other pressures on an independent Scotland in terms of how it developed its tax system be noticeably different to those that apply to a Westminster government, which have, as you've described, resulted in a very complex system. So there are two parts of that. One is a straightforwardly political issue, and I was talking yesterday a little bit about business rates, which have been a pretty stable tax in the UK as a whole, but over the last 3 years have been complicated with a whole series of things. I think that's actually happened in Scotland a bit as well. But the other issue is, of course, to do with international mobility and difficulties around avoidance, and a lot of the complexity is built up around trying to deal with that, and it's hard to see why that would be easier for Scotland. Indeed, it may be more difficult for Scotland. So the pressures here may be not so dissimilar. But as I said, the opportunity of this big change may allow significant change to things like the structure of tax and national income tax and national insurance, or the VAT system, or what have you.
Okay, thank you. I'll bring in Christian Allard.
Thank you, Convener. Good morning. I have a question to Paul Johnson regarding the Office for Budget Responsibility figures, because your report, the IFS is taking the OBR figures. So there are some disparity there, because OBR figures don't correspond with what expert or the industry is saying. If you see Professor Kemp, for example, he did say that the figures produced by the Office on Budget Responsibility were 6 billion barrels fewer than he would expect. On the same, my last visit to BP regarding the increase in the few years coming, they do show that from 2013 to 2017 and forward, there is an increase of production, which comes from the oil and gas UK. Even in the totals that the Scottish Government is saying of recoverable oil and gas number of barrels, the Scottish Government is talking about 24 million, when BP is talking about 27 billion. So it's looked like that there are some disparity between the OBR, great disparity between the OBR and the experts and the industry itself. So which one is right, which one is wrong? Who should we trust?
Well, I don't know which one is right. I think as Joe Armstrong said, the OBR and Department of Energy figures have generally actually been over-optimistic looking back, but they may turn out to be pessimistic looking forward. But I think so. I don't know what's right, but I think the key issue is that I think that uncertainty is actually the key issue. So it may turn out that oil revenues are significantly higher than OBR suggests, or it may not. But it strikes me it will be incautious to assume that revenues will be at the optimistic end of forecasts, and to plan budgets and spending and the fiscal policy on that very optimistic assumption. So I think the issue then is, as I know the Fiscal Commission is thinking about, is how do you account for oil revenues when you're setting your budgets and setting your fiscal policy. And I think you do have to think about them in a different way to other revenues, because they are historically, you can see how very, very volatile how very, very volatile they are. So I think the issue is less about who's right and who's wrong, and it's more about how to deal with the very significant uncertainty and volatility that are inevitable for what will be a rather large chunk of the revenues in an independent Scotland. And I think the simply assuming that that the optimistic levels are right and that you can pay for day-to-day spending all the way through with that, I think probably is not going to be an adequately prudent approach.
But BP are investing with S figures. That's their forecast. They are working with S numbers. So are other companies in the North Sea.
Well, that's as maybe, but my point is not I think they're wrong or that they're right,
Yeah.
but I think that in terms of planning the budget, one has to take account of the fact that these numbers are very uncertain. And if they're uncertain, then you need to think about these revenues in a very different way to the way you think about income tax revenues or revenues from VAT, because of the volatility that's inherent within them, and indeed the fact that in the long run they may disappear.
Professor Armstrong wanted to comment.
Yes, I wanted to pick up the point about the experts' projections. There are lots of projections out there, absolutely right. I think Oil and Gas UK 12 months ago was talking about a more bullish outcome than they're now talking about, so they themselves have pegged back their projections. The OBR's projections include the output based on the current record levels of investment, so it's not they're ignoring that output, they've got that included within it. And I think it's also important to reflect on the fact that the Scottish Government itself 12 months ago, slightly more than 12 months ago, prior to the knowledge that the 2013 output didn't bounce back, they had oil price projections by the end of the forecast period of ranging between 11.8 and 4.1 billion pounds per year. So the Scottish Government itself acknowledges that the range is potentially extremely wide. Extremely wide.
Is there a vast difference between OBR and...
No, OBR's within that range. So the Scottish Government's own scenarios are extremely wide. So again, it's about how do you use that information to plan your spending. It's not to say if it comes in we don't want it, but it's to say how do you plan your day-to-day current spending plans on the basis of that income, which is about 15% of Scotland's tax take, as opposed to 2% for the UK's tax take. So it's not something that's not wanted, it is, but it's about how do you use it to plan your spending. And the volatility the Scottish Government accept is extremely wide.
Yeah, just briefly, this point on volatility is very important. And one thing that we suggested 6 months ago is that the volatility, a bigger country with deeper pockets and its own currency can print, is probably better able to handle volatility. And so if you can agree an expected amount of oil that's there, an optimal thing to do, for once there is a free lunch here, economically you can show there is a free lunch here, is to do a swap between the oil and the debt, which would leave an independent Scotland at a much lower level of debt, which gives a whole different meaning to the debate, if you can do this debt for oil swap. Now, I understand politically that's extremely difficult, but it's something which, as an economist, I think that should be on the table. It is a genuine free lunch.
I just wanted to check on the question, and you can maybe answer it. Do you disagree with the forecast of BP themselves?
I don't have any view on BP's forecast. I simply point out that businesses can be overly optimistic and overly pessimistic at times. That's all.
Professor Armstrong, if I may...
one more question, Chris.
Yes, it was regarding your report from October last year. It stated that setting up both a stabilising fund and a saving funds, as the Fiscal Commission's working group has advocated, would be desirable outcomes. Can I ask you why?
Well, as an economist looking at the sort of a commodity that will be depleted and not renewed for generations to come, one would hope that they benefit from that asset. And if you set aside monies in a stabilisation fund or an oil fund, that allows you the opportunity to let them benefit in the future. Challenge at the moment is how do you do that when you've got a fiscal deficit?
But do you think the UK governments should have followed the Norwegian model? And
I think now they would accept it would have been nice to have had it, but they used it for other things. And Scotland benefited from those other things.
But there's still possibility to follow that Norwegian model for whatever happened in September.
The Norwegian model is a different model. It wasn't simply just taking the tax returns and putting it into a fund. The Norwegian model was about the Norwegian government actually investing in the North Sea, and the UK government at the time chose not to. It didn't have the coffers to do so at the time, and it used international capital to invest in the North Sea. The Norwegian government, because it was it was gas rather than oil, it didn't have the same desire, wish or abilities to invest at the same speed as the UK chose. So it chose to retain some of ownership of its assets, and it's the ownership dividends that are actually increasing the North Sea, the Norwegian fund, not Norwegian tax take.
That's an important point, because Sir Ian Wood in his report
Okay,
did agree with you on this.
Mr. Allard, you've had 6 questions.
Thank you.
We'll need to move on. I'm conscious of the time. I've got a couple of hours to ask supplementaries, and then I'm going to go to Richard Baker. But a quick supplementary from Mark Biaggi and then Joe McCullough.
The Office of Budget Responsibility gets a lot of currency, pardoning the pun, from being independent of the UK government, yet 2 of you have referred to it using Department of Energy and Climate Change analysis as its source. Is there any conflict there?
The OBR uses a lot. I mean, the OBR is an organisation of about 20 people, so they inevitably use evidence and data from where other people who are experts in the area create it. Their role, it seems to me, is to, well, I know, is to test that information. So they will, for example, if they're looking at how much tax that might be raised from a change in a tax rate, HMRC will do an initial piece of work, and then OBR will challenge that and refine it and chuck it out if they think it's wrong, or use it if they think it's appropriate. So I think it's independent in that sense. It's not independent in the sense they've got 500 people repeating from scratch all of the work that's done elsewhere across the economy.
I'd also say that you could argue that the Council of Economic Advisers has a similar challenge on its hands.
Quickly, you all talked about the volatility of oil and the fact that Scotland was dependent on oil for 15% of its tax take. Norway is dependent on oil for 30% of its tax take and has been exposed to the same volatility as every other oil-producing nation, yet the UK's projected debt is 1.5 trillion and Norway's in surplus. So how would you explain that?
Yep. So the key difference is the debt combined with not having access to your own currency. Again, in all of these things, it's not a question of looking at what happens when everything goes well. You've got to imagine what happens when things go badly, and how would this play out? What would the scenarios be? So oil volatility on its own, if you had no debt, I think that wouldn't be a great issue. It's problematic, but something which can be managed. But when you have a high level of debt, and so your potential to start borrowing when you have these big falls, if it's genuinely volatile, could be limited, and that's where it starts getting difficult. Your options start running out, and so the difference is you'd have here a currency. You'd be using somebody else's currency effectively, and assuming there's a deal on what would be the fair share of debt, which most people say is about 80% of GDP, then it's not the same as what would be in Norway.
I don't think that's a question I asked. I mean, the question is perhaps more simple that I asked. Why is Norway, a small country that's 30% dependent on oil revenue, doing so much better than the UK?
Okay, I'll try again. Because it has no debt. And
But the reason it has no debt is because it's got access to its own oil revenues?
So an independent Scotland would start off, I presume, with about 80% debt to GDP, if you take a per capita slice of it. That is the starting point. This fixed cost, plus the volatility, and the fact that you've locked the cupboard on one of the options, which is monetary policy. That's why it's different. Norway has its own currency. That's different. Norway doesn't have the same level of debt. That's different. Volatility, yes, but without those two differences, you can manage it.
Anybody else on the panel want to comment on this? We need to move on.
I think you're almost asking a kind of backward-looking question, which is why did, and I suppose the question is, why did Norway manage things better than the UK? I think is the question you're asking. And I think that's a very big political economy question. As Joe said just now, the UK did use the revenues from oil when they were very, very high in the 1980s, rather than salting them away in the way that Norway has. But you could ask that about any economy. Some economies have done better than the UK economy. Some economies have done worse than the UK economy. We've got higher debt than a number of economies. not partly to do with the fiscal regime before the recession, partly to do with the scale of the crisis as it hit the UK.
Yeah,
Okay, well, no, really, we need to move on because we're going to run out of time. Richard Baker.
So perhaps a state-owned oil and gas industry would be the right way forward then, but not dwelling on that point. I do want to continue on oil and gas revenues. I had a debate about debt, but whatever happens, Scotland won't be liability-free, and the cost of decommissioning the North Sea has been estimated as between 20 and 47.5 billion pounds. I understand the Scottish Government has made a commitment to underwrite that to the tune of 20 billion pounds. To what extent have you been able to factor that into any projections you've made on future revenue streams for an independent Scotland?
I've certainly not managed to, I don't have any model to project other than taking the straight line extrapolations. What the OBR is indicating at some point that will start to affect. And I think actually by the end of the current forecast period, although I need to check, I think it's starting to see some levels of decommissioning costs coming in. And what that means is that the tax take from some of the oil companies is reduced because they get reliefs for those decommissioning costs. As those start to ratchet up, that has effect on what tax actually then accrues to the UK/Scottish Exchequer, whichever be the appropriate body. That's presumably why the OBR's projections long term are for a long, slow, steady decline in the North Sea taxes as a share of national income because of that decommissioning effect.
So that may already be taken into account.
It's
what
certainly
is
in the long term
share.
projections of OBR, yes.
Yes. And my final question, then, Convener, I mean, the UK oil and gas most recent activity survey shows that what we have in the North Sea is hopefully a long future for it, but lower production and rising costs for the industry. So it's difficult to justify, isn't it, tremendously optimistic projections in terms of tax revenue for the industry in longer term?
I think it's important to differentiate between output and jobs and tax take, yes, because I think what the Wood Review report is suggesting is that in order for a long, very productive output from the North Sea, you have to look at having much more flexible or continuing to have flexible oil tax regime. That only means one thing, it's less tax per barrel than would currently be the case. But that's in order to maintain the life of the North Sea. So
you could sustain jobs in the industry,
yes,
but sustaining a high level of tax return is a far more difficult job to do, is what you're saying, Professor Armstrong.
Yes.
Could I just, I'm sorry this is repeating the point, but I do think the absolutely crucial point here is much less what different views of the future are and much more that there's just a lot of uncertainty and volatility here. And I would kind of urge you to listen to what Angus was saying earlier, because I think his view about this oil for debt swap is an extremely creative and a potentially very beneficial type of policy which would achieve, I think, precisely what he was describing, that you'd have a bigger economy, more able to cope with the volatility, swapping that volatility for some of the debt, which a small economy would find it difficult to live with large levels of debt. I think that kind of very creative idea, which I understand has political issues, but from an economic point of view, would benefit everybody involved. And I think it's well worth taking very seriously.
But that might also therefore involve agreement on responsibility for decommissioning costs, which doesn't exist.
It would be part of a very
actually becomes quite a complicated arrangement.
It would be a very complex negotiation to get what both sides felt was a fair deal at the end. But actually, because of the costs to an independent Scotland of both volatility and large amounts of debt, you could see that there's actually room for both sides to be better off within quite a wide range of outcomes. So it's exactly the kind of thing over which a negotiation would be the right way, in a sense, of going.
Thank you. Mike Mackenzie.
Thank you, Convener. My question was for Mr. Johnson, and I just wondered if he could explain why countries like Austria, Sweden, Denmark, Switzerland, the Netherlands, Norway have all got significantly greater levels of productivity than the UK.
That's if I knew the answer to that in a way which one could translate into UK policy, then we would have done it. I don't know the answer to that. There are all sorts of different elements to the institutional and economic arrangements within those within those different countries, which result in higher productivity. I mean, I'm not, UK productivity. The story of UK productivity is not a bad one, actually, up until 2007 at least. If you look at the period from the late 1970s through to the late 2000s, UK productivity increased faster than in most other OECD countries from a relatively low base. So it's not as is often described, a totally gloomy picture over that period. There were significant improvements in productivity over that period. There are clear problems in terms. I mean, there is a short-run big issue with productivity in the UK since 2007, where productivity has taken a significant dive, which has been related to a combination of high levels of employment, low levels of wages, low levels of business investment. Now, it remains to be seen. My expectation and hope is that that is a short-run phenomenon, and then things will start to get back something like on the track that they were before. It's pretty clear what at a macro or high level, the things that matter for productivity are a stable and efficient tax system, an effective education system, good levels of investment in public investment in infrastructure, a tax regime and a financial regime which allows investment by the business sector. So is it fair to say that relative to those other countries, the UK hasn't been able to provide that kind of regime that you describe? Well, we struggle for. Well, I mean, there are areas where we do well and areas where we do less well. So, in terms of some elements of our tax and regulatory regime, we are relatively competitive and effective. In terms of some areas of tax, certainly some areas of education, we're less effective. We have in the UK some of the least well educated in terms of literacy and numeracy young people, indeed people through the population in the whole of Europe and the OECD, but at the top end we're doing very much better. So there are, as with all these things, places where the UK is doing badly and places where it's doing better. Okay, thank you. And if I could just move on quickly to my next question, which is it's about childcare. You'll be aware of the fact that one of the policies that we Scottish Government is advocating is the introduction of universal childcare, and current calculations suggest that under the current regime, we would only receive back about 45 million of the enhanced revenues of 700 million that that policy would create. Do you see anything in what any of the other parties are proposing in terms of enhanced devolution that would give us the ability to introduce a policy like that, a kind of game-changing policy like that? Well, I think there's a sort of prior question about how effective universal childcare or increased public childcare provision is or would be in terms of increasing increasing revenues through increases in labour supply. I mean, actually, all of the main UK parties, as well as the Scottish Nationalist Party, are very much in favour of increased spending on childcare. Spending across the UK has risen very, very substantially every year for the last 20 years on childcare provision, and is now towards the top of OECD league tables, actually, in terms of spending on childcare provision. I have some worries about the way that this is being spent. The level, the evidence on the relationship between universal childcare provision and female labour supply is nothing like as strong as you might expect it to be. So I would not expect an additional X £100 million of spending on childcare to pay for itself in any sense in terms of additional tax revenue. So I take issue with actually the consensus. I think there is a consensus across all parties that more should be spent on childcare because it will have big effects both on child development and labour supply. I don't think there's any evidence for either of those statements. Okay, thank you.
Anyone else on the panel want to comment on that? Or? No.
Well, I made two comments. First of all, I think the evidence, particularly from the States, for early childhood interventions is very positive. But like Paul said, we've actually invested a lot in this for the last 20 years. And I think there's going to be a lot of more interesting work in that area. So I actually commend the Scottish Government's efforts in this area. I would also like to say the question about productivity, which is kind of the golden question, really. I think there's a very interesting piece of work to be done about the levels of productivity and the degree to which you have devolved or federal taxes. Does that actually help it? Because that's the nub of this. Is it better to make local decisions or central decisions? And I think that there's a very interesting piece of work that we'll be happy to do and send you those results.
Could I just clarify my points on childcare? I entirely agree with what Angus said about the positive effects of targeted childcare policies on disadvantaged populations. Those are expensive, those are well targeted, and there is very good evidence that they're effective. That seems to be not what any of the main parties are talking about in terms of their additional spending on childcare.
Right, thank you.
Just
briefly,
very briefly, just following on a question that my colleague Mike Mackenzie asked about productivity. One of the items in the Sperry report said that because of the weakness of the UK economy, potential benefits, particularly from oil revenues, to the UK economy have been squandered in favour of boosting financial services concentrated in London. I therefore go back to the question I asked earlier in terms of, do you see that anything in the UK that suggests that trend will not continue? And therefore, in face of that, it would be better, would it not, that Scotland controlled the economy on its own?
Mr. Johnson.
So, I think you can make a. I think you can make a serious argument that the UK had a lot of oil revenues in the 80s, which it used for day-to-day spending, and actually we had a lot of revenues from the financial services in the 2000s, which also used for day-to-day spending. That was not, in a sense, the UK as a whole did not follow a terribly cautious policy in making use of those revenues, in building up any kind of fund, or in recognising that those revenues will be lost in the long run. So, in a sense, I think I have some sympathy with your look back at failures of history, but I wouldn't speculate on who would do a better job going forward.
But it's related very much to the future, and that's why I asked the question about control within Scotland.
Right. Okay. We're short on time, so we need to move on. Marco Bianchi.
For those of you in the business of projections, I think Professor Armstrong gets a buy on this one. The models that I've seen are based on an assumption of taking on the debt, our share of the debt, but that's based on a particular model of it and has often incorporated higher borrowing costs. The Fiscal Commission, on the other hand, suggested an approach that now appears to be the one that would have to be taken, whereby Scotland would be financing a share of the UK debt. Now, does that have an impact on the projection? Because clearly then it would be the UK's borrowing cost level rather than any level that we might debate for an independent Scotland borrowing on the markets itself.
Well, I'll leave Angus to answer the questions about what the likely level of interest rates might be. But in terms of the long-run projections that we did, we've looked at the sensitivity of those projections to different interest rates, including an assumption that Scotland were able to borrow at the same rate as the rest of the UK, which I think is a fair, is certainly at the optimistic end of assumptions. The big story doesn't change terribly in terms of the long run. The long run, the big things driving what's happening in the long run is demographic change, which, as I say, happens for the UK and for Scotland, a little bit more for Scotland, depending on what happens to migration and what's happening to the tax basis. So clearly, higher borrowing costs create additional difficulty. But our long-run report looks at assumptions which include no levels of higher borrowing costs, and the big picture doesn't change.
Can I just check, that was in your so-called optimistic model, wasn't it?
Yes.
Yes.
From my side, so it wasn't actually a forecast. It was an estimate based on what had happened in the European Union between 2000 and 2012, where we actually tried to control for the crisis countries. So we tried not to get pulled in one direction from that. I assume that under that proposal, that as the debt matures, then an independent Scotland would have to pay a share of that debt maturity. And quite a lot of the debt is actually in the next 3 years. 3 years, in the yield curve. And so there would have to still be a lot of issuance. And the question is, what level of what price would people charge you for borrowing that money, knowing the debt that you will eventually take? Because we're just arguing here about timing, not the amount. We assume the amount's agreed, whatever negotiation is. Playing around with the timing is a timing issue, but the price is based on what I think is the probability of me being repaid, and that will be based on the level of debt that you're going to take on, not the timing of it.
But this is a relationship between the independent Scottish Government and the UK Government, and the UK Government has, after all, confirmed to the markets that it is ultimately responsible for all of the debt.
Absolutely. So the UK Government has done what was a very, in my view, a sort of very boring, obvious thing to do, is to reaffirm that the debt out there under Her Majesty's Government name will stay Her Majesty's Government, and you know, since they haven't done since Charles II, they will not default on it. The question then becomes, how do you strike this deal, and what are the cash flow payments, what is the net present value of that, and the agreed amount, that whatever that number is, if you take, say, a population share, which seems to be the estimate, that amount will drive what people, will be one of the factors that determine what people will require as rate of return, the interest rate for borrowing on that. Can I also just finally say, when we did the estimations, it was based on the European Union, which is, of course, a formal monetary union. If that's not on the cards, if that's ruled out, the interest rates will be higher.
Okay. To just ask a slightly different topic to Mr. Johnson, you've said today, you know, there's uncertainty based in all your projections, whether that's for Scotland or the UK. Is it fair to say that the revision that you've undertaken today and the observation that was published just shows the level of uncertainty that there is in any form of economic projection?
Yes, I mean, what we published yesterday was really updating based on the new information that was published after the autumn statement by the Office of Budget Responsibility. So there was some good news in there. That growth, their projections of growth were higher than they were back at the last budget, and so for the UK as a whole and for Scotland, things look a little bit better than they did a year ago, and there are also changes to their oil revenue forecast. So yes, these things change as forecasts change, and as we've seen over the last 3 years from the OBR, they can change really very dramatically indeed. So if we cast your mind back to autumn 2010, the government had hoped essentially to have dealt with the fiscal problem by 2015. Growth has turned out to be very, very much less than was projected back then, with the result that the fiscal situation is very much worse than was hoped. So yes, these things are, these things will be wrong without any question, but they are the best things that we have to work with at the moment.
And a final question to Dr. Armstrong. You seem to be quite supportive of more efficient taxation through the devolution of powers. Do you believe that all things being equal, greater fiscal powers leads to better economic performance? Or is that the purpose of the research that you were talking about?
No, let me just... All things being equal, I think that you can't, with tax, you can't take it in an all things being equal, a partial thing. If I just change this lever and pretend nothing else changes, would I be better off or worse off? I don't think you can answer that question because other things change. And so, do I think that there are, in my view, and this is without having done this research, are there perfectly reasonable powers which could be used already, and there could be greater powers transferred and to Wales and the Northern Ireland, the rest of the United Kingdom? Could the whole constitutional arrangement be redrawn in a more coherent fashion? My feeling is the answer is yes, without having done the research, but my feeling is the answer is yes.
Coherent, do you mean in a way that would result in better economic performance?
Correct. That's, there's a lot of non-economic issues to be considered here, which are perfectly reasonable. But from an economic perspective, it's about productivity and standards of living.
Can I just ask one follow-up to Mr. Biaggi's first question on borrowing costs? Dr. Armstrong, what is your estimate of borrowing costs in an independent Scotland if there were no monetary union?
Unfortunately, it's very difficult to say because we estimated it. You have to find a counterfactual. You have to find somewhere to estimate this on the basis of. And the European Union, taking the crisis countries out of it, provided a nice test tube to be able to do this experiment in. If you don't have a formal monetary union, well, which ones do you want to compare? Now it starts to get very messy. So unfortunately, I don't have an answer to that. What I would say is that they're more likely to be lower in a formal monetary union than in an informal monetary union. but I don't have an estimate.
Right, fine. Okay. Right. Joe McCall. Lastly.
Convener. My question's for Professor Armstrong. You mentioned in your written evidence that the future of the current Barnett formula arrangements, quotes, appear uncertain. You'll obviously be aware of the Hotham Commission that found that implementing its proposals would result in a £4 billion cut to the Scottish budget. So what challenges do you think Scotland will face if there were a no vote next year and the Barnett formula was scrapped?
I don't think the Barnett formula will be scrapped. I do think it will be adapted. I doubt if anybody would seriously suggest it's not going to be adapted, but it is a formula that has continued to be adapted over time, and currently it's been adapted as a consequence of, I think, the Hotham Commission, possibly guys from IFS, assisting this Welsh Assembly Government to identify the fact that non-domestic rates, the treatment of non-domestic rates is not similar across Scotland, Northern Ireland and Wales, so there's been adaptation already. The reason why I think there'll be further adaptations, I just think because the Welsh Assembly Government and Northern Ireland Assembly are now beginning to understand the pros and cons of having your own taxes, they are now pushing harder. I think you've also got that Scotland has a challenge in its hands, and it says it's been justified in having a higher per capita share of the formula because it has got North Sea tax revenues, and it is a significant benefit to the whole of the UK. As those start to decline, it becomes harder to justify to those in the North East or those in the South West that Scotland should get a higher per capita share if it can't prove the same needs requirements. And on a needs basis, the Hotham Commission clearly signals that it's difficult to justify Scotland in totality requiring the same level of support as other parts of the UK might currently require. So I think the move would be for further changes. I would also argue, however, in the basis of that it was a political construction in the first instance, that it would be politically negotiated around what changes would be required and what transition arrangements would be made. But yes, I do think there'll be a change.
Yeah. So I mean, you were saying you don't think the Barnett formula will be scrapped, but what you're saying is it could be adapted in line with Hotham.
I'm not sure it'll be Hotham. I think it will be a whole host of different analyses done, a variety of different bodies involved, not least UK Treasury.
Yeah.
I think Hotham is a opening shot and a negotiating position.
So you think the UK Treasury will be the determining...
Well, the UK Treasury currently hold the black box, so yes, the UK Treasury would be in control.
So the UK Treasury will decide Scotland's future after...
UK Treasury will offer Scottish Government the funding required, and it will be a negotiated settlement with politicians from all parties in all regions of the UK involved in that negotiation.
Right, okay, thanks very much.
Okay. Right, we're going to call it a day at that because we're already behind the clock. It's been a very interesting session. I'm very grateful to you for coming along and helping the committee, and we'll now have a short suspension for 3 or 4 minutes to allow a changeover. Right, if we can reconvene, thank members for coming back. We move on to the second panel this morning, and I'm delighted to say we are joined by Crawford Beveridge, the Chair, and Professor Andrew Hughes-Hallett, Member of the Fiscal Commission Working Group. Welcome to you both. Mr Beveridge, can I maybe just invite you at the start, if you want to just set out very briefly the work of the Commission?
Yes, thanks, Convener, and thanks for having us here. I won't say very much because I suspect people are mostly interested in what we've been doing about currency, and we're going to get into all of that. But just to say that we made a submission to you, which you'll have seen about 12 months ago or so. We published the potential macroeconomic framework for Scotland in the event of independence. And in that, we looked at the currency options, which has become partly one of the big focuses for everybody, which we rather expected it would be. We made, as I think you know, a strong proposal at that time for a currency union, which in some areas is now called the famous Plan A. And we really did believe that that was in the best interest of both Scotland and the rest of the UK. So today we can make some observations about that report and some of the other interventions that have gone on over the last 6 months or so. We actually are meeting again tomorrow, the Fiscal Commission Working Group, because we have a Council of Economic Advisers on Friday, and we tend to try and line them up when everybody's in town for those anyway. And so, you know, I don't have the latest thinking of that group of people because we won't know that until this time tomorrow. But I'm 90% certain that what is going to come out of that meeting is a belief that they will reaffirm their advice to the government in terms of that the right option for Scotland is a currency union. Certainly we'll look at the others. I think when you look at them, the evidence tends to push you all the way back again to a currency union as the best option for everybody. And I'm certain that in our future work planning, we'll be trying to take a little more time to see what we can do to show for the rest of the UK, because I think we can show easily for Scotland, but for the rest of the UK, what some of the advantages would be of such a union and what the disadvantages would be of going in a different direction. And maybe with that, I'll just go wherever you all want to go.
Thank you very much for that introduction. We've got about an hour for this session. I'd remind members, as I did earlier, on if they could keep their question short and to the point, you know, we can get through the subjects in the time available to us. I think you've already touched on some of the topics which I think will come up. I wonder if I could just start by asking you in relation to some of the evidence we've just heard, which I'm not sure if you managed to catch, but we had Professor Angus Armstrong, I'm elevating him, Dr. Angus Armstrong, I think he is, who is, I'm sure, whose work I'm sure you'll be familiar with in terms of a currency expert, who told us, if I noted down correctly, he didn't think it was either in the interests of Scotland or the rest of the UK to enter a formal monetary union, essentially because it would put too many restrictions on both parties and the element of risk sharing would be too high. Now, we also saw an intervention last week, I think it was, in the New York Times from the Nobel Prize-winning economist Paul Krugman. Now, I know you have a Nobel Prize-winning economists as part of your advisory body, but Professor Krugman said, thinking on the monetary union from the independence movement, I suspect he means yourselves, has been deeply muddle-headed. And he went on to say, sharing a common currency without having a shared federal government is very dangerous. Why is he wrong?
Well, I'll actually let Andrew answer some of this, but I can tell you we'll stack up our Nobel economists against that Nobel economist any day of the week. You know, I think Paul has very strong views if you read his columns regularly, and I think we would have responded had it not been that there is a lot of evidence that says when you take him on, he likes to go in for public fights for a very long time.
Oh, I think we'd enjoy watching that.
But we think I mean, there is no question that both he and Dr. Armstrong are correct in that there are constraints imposed when you go into any kind of currency union. Whether or not we were doing that, there would still be constraints imposed. The market imposes its own constraints on people, whether you like it or not. And if you've talked to the FSA recently, I think they just recently said that something like 80% of their regulation now comes out of Europe. It doesn't even come out of the UK. And so we just believe that the upside of this far outweighs the downside. But Andrew, you might want to... I mean, I'm a simple business guy, right? This is an economist. I just work here.
Yes, okay. I mean, that's essentially the point. No system is absolutely perfect in every single aspect that you might imagine. And so it is a question of balancing up pros and cons. I apologise, my voice has got Alzheimer's. It keeps disappearing and coming back. I'm a bit disappointed in Paul Krugman in that, because it shows not tremendous judgment, I would have thought, because it doesn't go into why there might be some restrictions. I'm not entirely sure. I didn't read the New York Times, so I don't know sure of the specifics of his argument. So if I go back to the Armstrong points on too many restrictions, too much risk sharing, I'm not sure how you can have too much risk sharing, or is it part of the restrictions? You have to. I mean, that's confused. I don't know what too much risk sharing means.
Well,
having risk sharing, sure, yeah. But too much.
Well, I think what you said was the level of risk, particularly on the larger economy, which would be the rest of the UK, was so substantial that it wasn't in the interest of the rest of the UK to enter such an arrangement.
That surely is, the risk is the other way around. I mean, if something goes wrong in the UK, it has much more effect on Scotland, proportionately speaking, than the other way around. I mean, if they, for example, went and had excessive fiscal deficits, that would have an effect on Scotland. The same size fiscal, and proportionately speaking, the same size fiscal deficit in Scotland would not have that huge effect on the rest of the UK. So I think that's, as I say, I think that's muddled. I mean, Crawford's absolutely right about the restrictions, in the sense that whether you're in a monetary union or not, in any system you've got to have restrictions. I mean, people talk about having fiscal restrictions in a monetary union, but they are the restrictions that stop you going bankrupt. I think, and I would hope, that you would recommend that whatever system was chosen, there should be some restraints on fiscal policies to stop yourself going bankrupt. I'm not allowed to say it, but you know, we don't want to go Greek. So there are natural restrictions in that case. So now consider what happens if you have that, and bear in mind those restrictions are on the difference between spending and revenues. They're not on either spending or revenues. It's on the difference between the two. And they're just the aggregates. You can do whatever you like with all the bits and pieces inside, as long as you don't have excessive deficit. Also, they don't have to be exactly in balance, but they have to be within reasonable bounds. And, of course, you would presumably want to have some restrictions on debt. If you have restrictions on debt, that would imply something on the deficits, and you wouldn't have to worry about the deficits per se. You just focus on the debt. That would make a lot more sense. But those restrictions are purely there to stop you going bankrupt. And the markets will take revenge if you're going to go bankrupt, because you haven't been sensible. But that's nothing to do with the monetary union. That would be there in general. It's nothing to do with the monetary union. You would have that and all the other options you might consider. So that's on the fiscal side. On the monetary side, of course, if you're in a monetary union, it depends which one you're in. If you're in what I will call a multilateral one, that's in this case bilateral one, it's shared between the two, which is Plan A, then you have a small, albeit small, but you have a small effect on policy, so you jointly decide on it. So there's a restriction. You can't do something which is crazy with respect to the other person. Or you have the one-sided one, which is not Plan A, but I mean, it's one that you can consider, and it's actually a useful point of reference. You don't have any control over monetary policy. You take what you're given from the other party, which is what used to happen before the euro came, when you were in the EMS, when it was German, in effect, German-run. But as I say, that may be a small sacrifice. And secondly, if you, again, were outside the monetary union, you're completely free, because you're in an interdependent world, for fairly obvious reasons, you don't have actually complete freedom to set your monetary policy. It's the same thing. You can't do something crazy, because if you do, you'll go, in this case, hyperinflation or hyperdeflation or something of this kind. So there are natural restrictions there. So I don't think you can argue there are too many restrictions. You might want slightly less restrictions, possibly, but then you've got to balance up the costs which come from elsewhere.
But would you accept, as Professor Krugman was suggesting, that to have a successful monetary union, you would need a high degree of fiscal integration?
Well, you probably do anyway. You don't have to have it. It'll be slightly more difficult to run if you don't have it. If you want to ask the nuclear question, which if we were doing this in Brussels, you would have asked, this tells you have to have a fiscal union, which is this kind of super form of fiscal cooperation. The answer to that is no, I mean, you don't have to. And I'm sorry for being pedantic, but you have to go back and look at the financing imbalances of the economy as a whole, and there are three. There's a savings investment one, which is to do with banking and the regulation of banking. There is a government spending less revenues, which is a fiscal deficit, and there's the trade deficit, including net factoring terms, so that's exports minus imports, we like to think it like that. And those three have got to add up. So it's entirely possible that you can be imbalanced in the banking sector, too little savings or something, or in the trade sector, and if you are, that will force the fiscal deficit to be too large, and you have a problem. But no amount of fiscal union at all will get you to control those two other ones. Right? So the fiscal union is not in itself necessary. It may be helpful, and a degree of coordination would be helpful, but it's not actually necessary. I mean, just need to be clear on that.
Okay, thank you. I've got one more question, and I'll bring in Chick Brodie. When you were doing your work, what historical models did you look at? And are there any examples of a country which has dissolved a political union and then entered into a successful monetary union?
Plenty have dissolved a monetary union, dissolved a fiscal union. I'm trying to think if they've actually entered, without being trivial, entered into a monetary union afterwards. And my history's not good enough what happened with the small guys, by which I mean Monaco or San Marino or something. It's possible it's true in those cases, but if you...
But you can't think of any examples which has followed this model.
You always need to start somewhere. I mean, just because there is an example, that doesn't mean to say I'm not going to try it. Okay. I mean, I can work out what to do. It's... I mean, there are lots of monetary unions without a political union, but I don't know they'd got there by having dissolved something first. Mr. Putin's making a good effort, but I mean, there are cases in the Caribbean. There are, everybody could. What happened with Belgium and Luxembourg? I suppose you could claim that was because after Napoleon that they broke apart and then ran a monetary union for a long time, but
that was
no.
You thought of one.
Yes, Austro-Hungarian Empire, and what dissolved left a monetary union between the Czech Republic and Slovakia. Okay, there's a long period of time in between the two, but that's the case in point.
Right,
and it was successful because the Czech-Slovak part was the most successful bit of the Austro-Hungarian Empire after the Habsburgs departed.
Because there was, when Czechoslovakia divided, there was a monetary union between the two parts, which lasted, from memory,
very short time.
5 weeks. Is that right?
Yeah. I mean, but that's their choice. I mean, there wasn't an economic crisis. They merely chose.
Okay, I'll bring in Chick Brodie.
Thank you. Good morning, Mr. Beveridge, Professor Hallett. Good to see you again, Crawford. I wonder if I may just go back to a question I asked in the previous panel, which was looking at the Standard & Poor's report, which indicated that the Scottish economy is rich and relatively diversified. Scottish wealth levels, it says, are comparable to that, and one of the countries named is Germany. And Scotland, even excluding North Sea output and calculated per capita GDP, only by looking at onshore income, Scotland would qualify for our highest economic assessment. I wonder if I may ask, on that basis, and the relative performance compared to the rest of the UK is some would say significantly better, but it's certainly better. I wonder if I may ask, in the current context and looking at the currency, I keep getting confused between currency and monetary union, but let's call it currency union.
Are they not the same thing?
No, not necessarily.
Well, maybe our panel could discuss that later.
That when you looked, and I know you're going to have another meeting tomorrow, when you looked at, in your first report, and looked at 4 currency options, is that right? You settled on a formal currency union between an independent Scotland and the rest of the UK. Can I ask firstly, why did you settle on that formal currency union? And given the, as I said, the relatively better performance of the Scottish economy compared to the rest of the UK, how was that decision, how was that decision arrived at? And given, as I say, the relative performances, how do you think the rest of the UK would look at that decision?
So, I mean, part of the reason we went down this route was, you know, at the moment, the economic cycles between Scotland and the rest of the UK are remarkably aligned. There is a huge amount of trade between the two places. Scotland's the second biggest trading partner for the rest of the UK. And so our view when we looked at it was, you know, that there are several reasons here. There's no particular reason why you would want to put the transactional cost of having people have to deal with a separate currency in the same island if you don't need to do it. Secondly, from the rest of UK's perspective, there are significant sterling earnings in oil and gas and our food and drink sector that would then disappear and cause them significant balance of payments problems into the bargain. And so, as we looked at this, we kind of concluded that yes, you could certainly go with other options, but they're all more disruptive to both sides of the fence than the one that we chose, which is why we thought it made a great deal of sense for both parties to consider it. Now, the economy does look strong, and that's another reason why we'd want to do it, because one of the concerns that I think was one that the convener was thinking about earlier was, you know, what happens if there's some kind of asymmetric shock because Scotland screws up in some miraculous way. And all the indications are that the economy is strong and that we're not going to cause huge problems for a partner in that kind of currency union. So there seemed no point in just because it's another idea to go off and say, well, we'll form a Scottish pound, but in the first instance, because that gives us a lot more degrees of freedom. As Andrew was saying, the degrees of freedom are somewhat limited anyway. And from a business perspective, we thought it would give great comfort to businesses to know that they were going to be in the same currency and regulatory framework, more or less, than they're existing under today. So those were the things that drove us down that route. Anything you want to add there?
Yes. Can I help on the currency versus monetary union? The currency union is the one I was referring to that's one-sided, right? So you don't have any input into the decisions being made in the other partner. And the monetary union is where you do have a little bit of input. It may not be huge.
Can I just clear, what you're proposing is a monetary union, that's your proposal?
But the Plan A involves a monetary union,
okay.
in which there's joint decision-making on the bits that affect money, i.e. the Bank of England end, the interest rates end, and so on.
Can I then, if I may, just pursue that?
Yeah,
because
sure.
I didn't realise it was bilateral. But in my understanding it was bilateral. But however, you're talking about formal monetary union. You're saying you're having a little bit of influence. We talked about things that will affect currency, like interest rate, the setting of interest rates. Given the current constituency or makeup of the MPC, what influence do you think an independent Scotland would have by having one person sitting on the board of, is it 9?
Against another 8, yeah.
Yep.
So it's 1 in 9.
Yeah.
And the answer is, if there's severe disagreements, rather little. If there are not severe disagreements, and there's no reason to suppose in normal course of events the disagreements will be very wide, because, as Crawford says, the convergence, the cyclical correlations, if you like, the amount by which the economy is effectively the same on the monetary front, is relatively small. That wouldn't happen very often. The only time, if there's a severe disagreement, would happen, and this does happen with the MPC every now and again, that they get a 5-4 vote, and you're the swing vote.
Yeah.
So, you know, like Saudi Arabia, with their oil pumping, you can actually change the world at that point, but it's not something you would get very often. The other side of the business, in that is important to think about and keep in mind, is you have a flow of information in terms of what's happening in the Scottish economy down to the Bank of England who's making the interest rate decisions. And that may make a difference to how they decide, not to the voting, but to the tone of the discussion and what they finally decide. And proof of that, if you speak to any of the governors of the national central banks in the Eurozone who don't control monetary policy because they're a member of the committee that makes the decisions, they have to either influence the voting, which they may not be able to do. Germany, who's the biggest economy in there, but not in terms of votes, can't do very much. and has got annoyed because of that. But if you speak to someone like the Dutch, they'll tell you flat out what they've done in their central banks since going into the monetary union is they've doubled the size of their research departments because they need to be able to go down there and say, this is the state of the economy as we see it, and this is what we would recommend as being sensible as we see it, and you can have a lot of influence that way.
Okay, that's very encouraging. One last question, if I may. I think you've touched on the aspect of fiscal flexibility. Perhaps, if you wouldn't mind, Professor Hallett, expanding on that, and given Mr. Beveridge's background, what do you think would be the impact on small businesses, particularly in the event, in the event of Scottish independence and the harmonisation of the currency?
Well, the currency is harmonised at the moment, so following on from your last question, you don't expect major changes in the monetary policy, the way that interest rates would unfold, and there is not the evidence we have. And I've done quick checks after Governor Carney's speech on the degree of convergence. The usual thing you would do if you're talking about a currency union, monetary union. Yes, I'm going to slip up too.
Sorry.
But I know what I mean, but it's not necessarily what I say. The differences you would want to have in the interest rates are rather small. Well less than a percentage point, I mean. So it's not really there, it's the fiscal flexibility that makes a big difference. And here I'm sure the smaller businesses would find that very helpful, because it's entirely possible, if you have your own taxes, to set them up in such a way as it helps them. So, if you want to get specific, I guess it's outside this committee, but I mean, you can get specific as to what you might do with which tax to help which sets of businesses. So one example would be to give some assistance, some effective assistance on research and development expenditures, knocking it off corporation tax, something of this kind as an allowance. This is the sort of thing you can do. That's just an example. This is the sort of thing you can do. And it's the flexibility of that, which at the moment we can't do. So that's where I would come at it from that point of view. You might be able to persuade the banks to lend a little bit more too. But that's a different kind of thing. That's on the phone, I guess.
I don't think it would make a huge difference to our small businesses, particularly those, obviously, that have that do a lot of business with the rest of the UK. We'd obviously find some comfort, I think, in this, because for them the transaction cost changes would be much larger than it would be percentage-wise for some of our larger companies. So I think small businesses on both sides of the border would welcome this greatly.
Thank you. Margaret McDougall.
Thank you, and good morning, panel. It was really just on the monetary union, where we've heard that your plan A has been dismissed, if you like, by the Exchequer. So can we then ask you, can I ask you today what your plan B would be if, we've heard that plan A is off the table?
So remember, we didn't call it plan A,
you didn't,
right?
Yes.
We called it a recommendation to the government. Others decided to call it plan A. And so I think the answer is that I don't think any of us on the committee believe for a minute that the Chancellor is serious. And that the cost, particularly as he thinks about an election for himself, the cost of trying to explain to the thousands of businesses that do business in Scotland, those that are in the rest of the UK, why they have to go through this transaction cost. The fact that he would have to go figure out what to do about some of these, the loss in the trade imbalances because of things like oil and gas and whisky. And, of course, the Treasury statement around the fact that they agree that they are totally responsible for the debt and therefore need not necessarily require us to take any, which would give them another $5 billion a year problem, all tell me that, just like we do in businesses, when there are opening salvos of things, we take positions. Whether we're dealing with what do we do with a labour union or what do we do about mergers and acquisitions, people take positions. And funnily enough, 90% of the time deals get done. And I think what would probably give us some comfort also in that statement that he made was that, remember that was made by on advice of his own permanent secretary to the Treasury. And he built in some wiggle room. If you read his actual statement, he said he would advise against the currency union as currently advocated. So like all negotiators, he's said, well, tell me a different way, and maybe we'll have a chance to get this done. So we warned in our report last year that leading up to this, there was going to be a lot of political statements. But in our opinion, economics will trump the politics in this, and good heads will prevail if there happens to be a yes vote. So we would not want to even talk about a plan B at this stage of the game. I think we would say there are lots of options, but at this moment, our strong advice would be, let's go down the path of recommending to the government that they stick with the monetary union, and we will spend some time on the Fiscal Commission Working Group over the next few months trying to help the rest of the UK understand the very strong advantages there are to that and the strong disadvantages there would be if they decided to go against that.
Mm-hmm. But is that not a bit like sticking your head in the sand and saying, well, no, we'll manage to come out of this, we'll negotiate something? I would have thought that you should always have a plan B. And
it depends
is
on
there a preferred option?
Depends on your negotiating style. I mean, I would say to people, if there is a very strong reason why you want to do A, if you admit very early on that you'd be willing to do B, then you very much weaken the ability to keep pressing for A. And so, you know, at this moment, I just can't see that all the looking that we do at the other options always lead us straight back to Plan A as being the one that makes the most sense for both sides of the border. So, I don't know, Andrew, if you want to.
I can add a few things. Slightly different things in the sense that I don't do politics, I do the economics. And the point of that remark is that in the last year, what's changed is the politics, not the economics. So if we're going to offer advice and a recommendation on the economics of what's sensible or not, it's unlikely to change until the economics changes. It's important in that context to realise that politicians often would like things to be different from the way they are on the ground, and so they will push a particular line. But the politics does not survive unless it's aligned with the economics. When dealing with students, you know, they often say, yeah, but what about the politics? Well, that's true, but look at the examples of political affairs which have got screwed up because the economics went wrong. My favourite example would be the Soviet Union. It took 70 years, I have to admit, but it screwed up for economic reasons, not political ones. And although you may not subscribe to this, but if you look at the euro, that's another political operation which screwed up because the economics didn't play along with what the politicians wanted. And that became obvious the moment that France and Germany announced they were not going to pay a fine on excessive deficits. And then the whole thing becomes incredible and people just overspend. I would add just one other thing to Crawford's observations about the get-out clauses in that letter. I understood from the speech that Mr. Osborne made that he said there was no legal reason for throwing this Plan A out. Sorry, there's no legal reason for agreeing to the Plan A. That suggests to me that he thinks that there are other reasons. And so if I can try and put that into context a little bit, and I said earlier that the unilateral currency union, I got it right, that's the one-way one, in which you just, in effect, take the pound anyway. You'd be in Scotland's position, as far as monetary policy is concerned, that would be exactly where we are now. The difference would be, on independence, you would have all those extra fiscal policies. So Scotland has to be better off, because it's got all these extra instruments it can use to promote its own economy, and it can decide whether to do that or not to do that or whatever, but it has the opportunity to do it. So Scotland has to be better off. But then view it from the rest of the UK's point of view, and this is important here, there is a cost to not being in Plan A, and that is they will have exactly the same monetary policy as they have now, since nothing on the monetary policy side has changed whatsoever. But they've lost some revenues, and they have faced the risk that some of the fiscal policies being done in Scotland, for whatever impact they may have on the south of the border, will not be to their advantage. So they have to be worse off, no question. Right, there's a cost to not agreeing. Before the referendum, they're unlikely to talk about it. After the referendum, if they're sensible, discretion will be the better part of valour. So, as we said earlier, when you look at these things, and I can go through all the other, I've got, I think, 7 options down here of other plans that you could, but we don't recommend, follow. If you go through the logic of them, then they all will lead you to the same kind of conclusion, that Scotland's going to be better off to varying degrees, and I've taken the most obvious example, but the rest of the UK could be worse off. There is a cost to not being in it.
Last question.
You know, I mean, I don't agree that at the moment we have a currency agreement, because we do have influence just now. You know, we don't have a, you said we have a currency union at the moment, but we do have influence at the moment, whereas if it was an independent Scotland, we wouldn't have that influence if it was a currency union or sterlingisation. I mean, we heard from the panel earlier today that Scotland having its own monetary unit would be currency, would be the best way forward. Are you saying that you disagree with that?
Essentially, yes. I mean, we looked at that very closely, and obviously we'll continue to look at things to see if the economics of these have changed as the Fiscal Commission meets. But at the moment, as Andrew says, that we don't see any particular economic evidence that would change our view that the absolute best thing for both parties here would be to go into a union.
I would question how much influence under the current regime we actually have. I haven't got it in my folder, but there was a quote from Mervyn King when he was Governor of the Bank of England that he would not do anything to change policy in order to help Scotland. That seems to me a fairly clear statement that they don't have any influence.
A brief supplementary. Mr. Crawford, many people watching this will not find that, or will find that not believing the Chancellor is serious is simply not a strategic approach to this very important issue. And surely any business in examining proposition will always have a plan B if something goes wrong with the preferred option. And we've just heard from Professor Hughes Hallett say there are several alternative options which the Commission's looked at. Wouldn't it be the sensible thing to actually put forward to the people of Scotland what you believe of those options would be the preferable alternative if we can conclude that, in fact, the Chancellor is being serious, which in all likelihood he is?
Well, I think our view on this is that at the moment we would continue to express to government. Remember what we're doing here. I mean, we're not setting the politics of this. We're only doing the technical end of this, right? And our view would be that we would put forward to government what our best option is, which we still think is union. Now, if the government wants to go ahead and say, we're going to pick one of the other ones as a backup, that's entirely for them to do.
So you supplied those options to the government?
They're in the report. Yeah, they were in the report that we produced 1 year ago. There were four separate options there. But we would strongly support the view that the sensible one for them to follow is the one that we proposed.
Okay, thank you.
Thank you, Convener. Good morning. Earlier, we've heard from previous expert witnesses who've suggested that if we were to have a monetary union without a political union, there could be risks to the rest of the UK because an independent Scotland, if it didn't like the way things were going, could just pack its bags and leave that monetary union. Do you think that's a likely scenario?
You know, macroeconomic systems change over time. You know, I would never say never to anything. But, you know, if you look at just the history of the UK between going through the exchange rate mechanisms, thinking about for a while about whether it ought to be able to join the euro and putting up certain tests for being able to do that, and then the Bank of England becoming independent, and then the Bank of England going for forward guidance and so on, the macroeconomic framework changes over time. All we were saying was that for the foreseeable future, as far as we are happy about looking forward, there is no particular evidence that says that just deciding one morning when you get up, we're going to change this and go into a Scottish pound or something, is likely to happen. But, you know, I mean, if you look at the Irish case, for example, they used the pound for about 50 years or thereabouts before they decided to use the punt, and used that for several years before they went into the euro. Something changed in their environment that said they ought to make a change. You know, what could that be? I have no idea, but it's certainly far enough out that we can't perceive of anything particular going wrong there. And on the issue of, you know, back to the could we cause serious disruption, I mean, you cause disruption not just for somebody else, but for yourself if you make sudden decisions about things. Anything that we were going to do would have been would presumably be well thought through in advance and negotiated with neighbours and worked out in some sensible way. You don't just wake up in the morning and say, let's have a Scottish pound instead. And I would remind you in terms of the other options, and perhaps for Mr. Baker also, that no cataclysmic event will happen on the 19th of September. You won't suddenly get there and say, oh my goodness, we've got today to go change a currency. There's then a long period of negotiation that goes on, and I believe, with respect, sir, that during that period that we will see a very different set of views coming out of Westminster than we see today. If we are wrong, then there's a couple of year period when you can go off and decide what it is you want to do that's different from that. But the agreement that was signed in Edinburgh between the two parties said that they were wanting to enter into, they would want to enter into amicable and constructive agreements with each other, and I just can't believe that just out of sheer spite somebody would say we're not going to enter into an agreement along those lines.
Okay, thank you. Do you have a view on that, Professor Hughes-Hallett?
Yes, I would add that one point is, if you're in a political union, I mean, the implication, presumably, of what you're saying is if you're in a political union, you're locked in, even when it goes against your own interest to be so. If you're in a monetary union, the point here is, because you don't have the lock, you have to pay attention as to whether it's in everybody's interest or not. Otherwise, something will happen. So it tends to produce much better results because it makes you actually cooperate as opposed to tell people what to do. Okay. Second thing is, what your point isn't about changing the regime. Is not restricted to the political union. Within the political union that has existed, the fiscal regime has changed every 10 years in my professional life. And somebody was pointing out to me yesterday, uncharitably, that the tax regime in the North Sea has changed 16 times in the last, I don't know, was it 5 years or something? These things happen all the time. The political union doesn't lock it out, actually.
Thanks very much for those answers. If I could move on to a different area. Which constitutional settlement do you believe is most likely to develop an economy that closes the dreadful gap we see between the rich and poor in this country?
So that's a little beyond the remit of a fiscal commission working group, I'm afraid, and I'm not sure I want to get into that territory. But what I might say, and perhaps this is just on a purely personal basis rather than dragging my colleagues into it, is that I am a little disappointed that the debate, while the economy is going to be very, very important to us, and the choice of currency, all these things are very, very important to us, I think we've missed the point that the reason of having good, strong economies is to try and form the kind of society that you want to live in. And I don't think we're spending nearly enough time talking about the fact that all the signs are that the current policies that we live by cause greater and greater inequality, large numbers of people in poverty, and these are things that are not getting appropriately addressed. So, I think under any constitutional structure, those are issues that have got to be thought through. And the government, as you know, at the same time, roughly a little earlier than they produced their white paper, did produce economic policy choices for Scotland in a different paper, which suggested that they would want to go down very different paths to try and sort out some of those very issues of how do we bring all the people back into the system. But it's a little beyond our remit to try and make these kinds of decisions.
Professor Hughes-Hallett, do you have a view on how the taxation system could be improved to address those inequalities?
Well, I'm sure that we can come up with answers on that. Professor Merlis has been spending his entire life and getting Nobel Prizes for talking about exactly that. The point I would make here is redistribution is a hell of a lot easier if you have your own tax system. So you're not locked into somebody else's. So that's one point. And the other point is, again, having your own tax system can be used to promote growth. Now, that may widen the inequality gap, but it may also be done in order to close it. Look at Scandinavia. That would be sort of, to back up your other redistribution plans by getting more people into work, etc. So it's going to be easier to do that way.
Thank you. Thank you, Convener.
Dick McKenzie.
Thank you, Convener. A question for Professor Hughes Hallett. In the first panel we heard from Angus Armstrong, and I just wondered what your view would be, or view is, on the National Institute for Economic and Social Research analysis on debt.
That's a good question. If you've got a couple of hours.
Sadly, you have a couple of minutes.
What you're referring to, presumably, is their concerns that the possibility of debt creates a risk premium on interest rates, and that makes the performance of the economy worse. It's going to affect investment and future growth and so on. And that's one of the papers I have looked at and thought about a little bit. And there are a number of points that I'm not very happy about in that paper, the way they've done it. And this is a bit technical. But risk premium on the interest rates, there's always two parts to the risk premium. That's why it's in the plural. There's a currency risk. That's to say the currency will depreciate, or that inflation will build up, or whatever, as a result of monetary policy. And there's a default risk that the government won't be able to pay its debt back. So there's two parts to that. Unfortunately, the way they ran their analysis, they've only got explanatory variables that tell you how those risks work from the debt side, or debt and deficit side, but from the fiscal side. They don't worry about the currency risk side. That means to say that those two variables have to work, as it were, twice as hard in order to be able to explain both parts. So you get an exaggerated effect. Yep. So that's a problem. And to illustrate, because I don't know, I can't rerun their analysis, I haven't got their data or anything. But what I can do is check the predictions against what's actually happened in specific cases. So everything is done in ratios of what Scotland's fiscal position would be relative to the UK for Scotland, and everything then, you can then take in a comparable case where the ratios are the same, but within the Eurozone, which is just the default risk part. And so if you look at Austria, its ratios to Germany are exactly the same as the ratios of Scotland to the UK, almost to the percentage point. And it predicts a risk premium of 4%, the model does, for Austria. It's actually, at the moment, 0.4%, so it's 10 times wrong, if you understand me. It predicts a risk premium from Japan of 8%, where actually Japan has 1% lower than Germany as its interest rate. So it's just way over the top in terms of biases. So really they need to do it a different way. And there are other analyses out there which look at these things, and they have a much wider set of explanatory variables. And the fiscal ones typically, except for in severe crises, so around 2009-10, you'll see the fiscal variables coming in. The rest of the time, they don't actually have much impact. It's to do with liquidity in the markets. It's to do with coefficients of risk aversion. Sorry for being technical, but there are lots of other things that I can bring in there. Trade imbalances, all of these things.
Are you sorry you asked now?
No, not at all. No, not at all. And the thing that will stick in my mind there is that description that it's over the top. So, and just following on from that, then the Treasury analysis that was done, just before or published just before George Osborne's announcement that we weren't getting to keep the pound, and I just wondered what you thought about that, and particularly how risk is calculated in that analysis.
Yeah, that's another one I looked at. The reason I should explain to the panel, the reason I'm looking at these ones is because this actually is, butting on immediately on my own academic work. So I looked at the model of that one, and the various points to make about that, and I'm sorry, it's another hour. But that's a model which has got, how do I put this, a fixed steady state. So in the long term, the economy will always have the same set of numbers. That's what they've used to calculate the risk and hence the interest rates. There's no growth in it. And much more worrying, since those risk premia are going to come from the fiscal side for deficits and debt being too large, there is absolutely no fiscal policy in it. There is nothing you can do, zero you can do in that model, if it were true, to get your deficit and debt down. That doesn't seem to be a very sensible way of going about it. We might as well go home and go to bed because there's nothing you can do. Then I got excited because then I looked down, how do they introduce the risk premia and affect the interest rates? And the risk premium, there's only one risk premium in the entire model, and that's for Scotland. The other three countries, which are the rest of the UK, the rest of Europe, and the rest of the world, they do not attract risk premium at all. Right? So it's impossible for them to have a problem, but it's only possible for Scotland to have a problem. And on top of that, the way they calculate the deficits, and I hope I get a laugh for this one too, the way they calculate the deficits is it's got three components. There's the structural deficit, that's the long-term deficit, and that is on average, not in every year, but on average fixed at some number, which you can't get away from. You've got the cyclical deficit, on average across the cycle is 0, and then you've got a contribution from oil price, from oil revenues, which will be positive. The other two deficits are then negative. Right? So the only person who's got a possible chance of getting out of having a deficit, according to this model, is Scotland, because if oil prices go up a lot, the positive will begin to outweigh the negative.
I interpreted all that as they fixed the numbers.
Well, I mean, put it another way, I would not let my students, even in the first year, get away with that. So they need to look, my bottom line is the Treasury needs to look at their recruiting policies.
Yeah, thank you very much again. And what will stick in my head again is from Mr Beveridge, they fixed the numbers. And just one final question. The Treasury have showed that the banking sector, they've suggested the banking sector is worth 12.5 times our national income. Would you care to comment on that?
Yes, we've taken a long look at that. It's simply not correct, and it's another occasion where the numbers do not reflect reality for a number of reasons, one of which is that it did not take into account where many of the big banks, RBS particularly, have some of their investment banking activities. It was a very backward-looking view that was probably correct at the time that they looked at it. Looking forward with some of the reforms that are going on in terms of European Union reform of the bank, Vickers, Basel II, all these kinds of things. If you analyse that going forward, you get a very different set of numbers, which are very much in line with the numbers in the rest of the UK. So I think we need to not look backwards and project it. We need to go look forward as to what changes are going on in the banking system and actually understand the numbers in that way. Is that fair?
That's fair. That's fair. I mean, and the point that he's making is that this will happen automatically. I mean, if you think of Vickers, it's going to be introduced. If you think of the, I can't remember its exact name, banking law, which came in December 2013 in London, and so on, this will cause what they're pleased to call in the Standard & Poor's re-domiciling. So in other words, the way the accounts work, that 12.5% of it, 12.5 times, 11 times will get reallocated back down to London.
A very different number, for example, might be that there's been recently an experimental series of tax revenue statistics done by HMRC, and they estimated Scotland's share of the bank levy, which is a charge on the balance sheet of the banks, to be 7.3% of the UK total, in sharp contrast to nearly 25%, which would be required to meet the Treasury's number. So I think there's a lot more serious analysis needs to be done there.
Okay. Yeah. Thank you very much indeed. That's very useful.
Okay. We're getting a little bit behind the clock, so we need to sharp up a bit on questions and answers. John McCall.
Thanks very much. You said earlier that you, Mr Beveridge, that you don't think that anyone on the committee believed that the Chancellor was serious in his speech about the currency union and Scotland's right to share the pound. Would you extend that to the other politicians in UK level who've made the same comments, such as the Shadow Chancellor of the Exchequer?
It was a little curious that it all happened at the same time, and an unusual degree of cooperation between the political parties, which was kind of interesting. Maybe I'm being too harsh on him to say that I don't believe him. What I would rather say is that I think all of us expected, and we indeed put in the report, that politics would prevail up until the time of the vote, and that we would see political, not economic statements at that time. I believe that if there is a yes vote, and they were serious about the signing of the Edinburgh Agreement around reasonable and amicable negotiation, that we might see a very different discussion going on. So, and I think that would be the case, because the economics are so sound, that would be the case whether we have a Labour government in power in Westminster or a Conservative government in power. And so I think there's, you know, that whoever tells you this is giving you a political, not an economic view.
Thank you very much. There's quite a lot been said about your Nobel laureates, and I noticed that one of them, James Mirrlees, was actually quoted by Governor Kearney in his speech when he came to Edinburgh a few weeks ago. You know, given the prestigious nature of your committee and the admiration of Mark Kearney, what discussions have the UK Treasury had with you? I take it that they must have got in touch with you to discuss your report.
Alas, no. I mean, we have tried very hard to engage the Treasury and others on these things, and they do not want to have these discussions prior to an independence vote taking place. That's been in marked contrast, I have to say, to the Bank of England, who have been very willing to open discussions with us, and so not with us personally, but you know, with our representatives, and so I think there's a great deal of discussion that could usefully be done in advance. But I can understand a negotiating position that says we don't want to talk about this theoretically. We'll only talk to you about it when it's practical.
Right. So. Thank you. Yeah, one more question. I wonder if I could take you back to the point that you made about Nick Macpherson, the Permanent Secretary of the Treasury's letter to George Osborne, where he said he wouldn't advise a currency union as currently advocated, and you described that as wriggle room. What do you think he meant as currently advocated? Well,
I think, as I was trying to say before, I mean, I think that was very clever language that I would expect very good negotiators to use, which just allows them to say that if they want to come back into a negotiation, that they never ever said it couldn't be done, that they said it couldn't be done as it was currently advocated. And so if we can negotiate around how it might change, then there's an opportunity to do something like that. And I think, you know, if you talk to, I don't know how many of you listened to Peter Curran on the radio last Saturday morning, you know, I mean, talking about negotiation skills. I mean, he would tell you that that's something that all good negotiators do. They always leave themselves a little space so that when reality starts to bite, you don't have to lose face over things. You can explain it in an entirely different way.
Thank you very much.
I seem to recall I was debating with Mr. Curran on that particular programme.
I understand that. Yes, it was. I read the transcript with great joy. So well done,
Richard Baker.
We've heard from Crawford Beveridge on the Commission's hit it and hope approach and its preferred currency option. But Professor Hughes Hallett, you've previously said that you thought that an independent Scotland in the European Union would at some point in the future be required to join the euro. I wonder if that was still your point of view, and to what extent, therefore, you thought euro membership might offer an alternative currency option for a separate Scotland in the medium or longer term.
It certainly could offer an alternative in the medium to long term. It's one of the many, as I said, I had a list of 7, that's one of them, of alternatives that could happen. It's not the one which I think is most suitable. And again, I said I've run the numbers on the tests of whether you're a good candidate for a currency union or a monetary union with respect to Scotland with the UK, or the Scotland with respect to the euro. And at the moment, it's far, far better to be with the UK. It satisfies those criteria much better, so there'll be much less asymmetries and possibilities of things going wrong if you went with the pound. So that leaves it there. But, you know, technically, I mean, if London slams the door shut totally, so much you have to think of something else, that's one of the many options you could try. Not necessarily the one I would recommend. I mean, we haven't ranked them, and I wouldn't rank them, but, you know, it's in the report that that's a possibility. It's also in the Treasury's report of April 2013, which also listed these things. And we're at one point at which we're one with the Treasury.
Very quick follow-up. So you don't any longer believe it would be a requirement in 2, 3, 4, 5 years' time of European membership?
No, that's very difficult to explain. This is not actually a treaty, as I understand it. This is an agreement. That's the first part. So the force behind it is different. It is expected, but you can see that some of them don't. And Sweden is the classic example. It was told it had to be. It doesn't go into the ERM2, which is one of the conditions for getting into the euro, and that's voluntary. Nobody can make it do it. and nobody's complained that it hasn't done it. So it's one of those wobbly things in the Euro system.
I won't extend the debate on the European treaties and the detail of their impact, so I'll leave it at that.
Okay, thank you. Okay, two more members need to get in. Marco Biaggi.
Thank you, Convener. What do you think the practical impact has been of the UK government's announcement that it is legally liable for all of its outstanding national debt?
I mean, a practical possibility from that is that Scotland, if it, I suppose, felt that it was not being negotiated with reasonably, would have no actual liability. I mean, the constitutional law expert at Edinburgh University, Christine Bell, said legally, under international law, the position is clear. If the remainder UK keeps the name and status of the UK under international law, it keeps its liabilities for the debt. The UK took out the debt and legally it owes the money. Scotland cannot therefore default. So now, but the whole point, it seemed to me, of the Edinburgh Agreement was that we weren't going to stand by what was legally here or legally. We were going to sit down and amicably agree what we ought to do. And that's why I think that statement alone is one of the reasons why I think whatever Chancellor is in power at the time will want to sit down and talk to us reasonably about other aspects as well.
And one of the reasons we have in the UK at the moment such a large national debt is the UK's economic management over the past 17 years, I suppose. How do you think the UK has done in managing the so-called fiscal rules, either the ones under Labour or the ones under the Conservatives?
I think I will defer that question if you don't mind. If Andrew wants to answer it, that's fine, but it's way beyond the remit of the group that I share.
Well, I mean, they over the years they've not had much in the way of formal rules that you can identify. Towards the end, that's to say, in the 2000s, there was an implicit rule, I suppose. I think it was an understanding rather than a formal rule that debt would not be more than 40% of GDP. And the impact of the recession. And my Scandinavian academic colleagues will tell me because Britain at that point was not well prepared for a downswing and therefore was in a bad, already in deficit and in a bad position to withstand it, it got much worse. So that rule went out of the window, and there was a rule which was talked about called the Golden Rule, which says you balance the current spending across the cycle, but you borrow for capital investment purposes. Which was part of the setup, as I understood it, is still part of the setup in Germany. So it's, this is a reputable rule. That disappeared as well. So really, whether we're talking about the rest of the UK or Scotland, you need to get back into having some rather more firm ideas to what those rules are. And with another hour, I'll explain exactly what I mean. But I'm just making the point. You need the rules. And the important thing about the rules, if you have them, is they must be seen to be obeyed, right? To make them credible. It's the same as dealing with your kids. If they misbehave, just saying, if you're naughty again, I won't like it. That's not going to do very much. It's got to be seen to be obeyed.
I believe the current Conservatives have a pair of rules that are slightly adapted from Labour's. One is that they should get back to the borrowing only to invest cycle over 5 years, and the other is that the national debt should be falling by 2015-16. At least that was the intention at one point of the Chancellor. I take it that it's, in your estimation, little chance of that.
No, and the problem is they're quite specific to the current situation. Not that that's silly. I mean, you need to get out of the current situation, but they're not rules that you put in forevermore, because it wouldn't mean anything. So I would work at quite a different set of rules, and I would make sure the debt was the focus of them rather than the deficit. That's what makes you go bankrupt, is not being able to service the debt.
Just on this question of debt, when the Scottish Government came out and said, if there's no monetary union with the rest of the UK, we might not take responsibility for debt. Was that something that was based on advice from the Fiscal Commission?
I mean, I can't answer, what was in the minds of the government at the time they did that, but it wasn't something that was in our report.
Right.
But at that stage, of course, it never occurred to us that there was not going to be genuine and reasonable negotiation. So we hadn't anticipated that Treasury statement was going to come upon us. And as I said, I still think that there is room on both sides to step back from those kinds of statements and come into into some agreement.
But in the view of the Fiscal Commission, would it be wise to take that approach?
I mean, that's really a political decision to be made. It's part of the negotiation that has to go on. I think it's certainly, it sounds like from the constitutional lawyers that it's well within the rights of the politicians so to do, but I think they need to be left to negotiate this on their own. We're just pure tinkerers at the edges here.
Okay, because Dr. Armstrong told us earlier he thought there'd be very substantial risks attached to that approach.
I don't.
You need to go a wee bit further than that. What risks?
Well, in terms of the view the international monetary community would take upon an independent Scotland that hadn't adopted a share of UK debt.
That's a possibility, but I think it's overblown. There are lots of studies of countries who have actually defaulted in the normal sense. We're not talking about that here, but an outright default. I mean, Argentina in 2001, and they're back in the markets shortly afterwards. Okay. So I would not get too worried. I mean, it's not that the point's wrong. It's just that you can overemphasize it.
And remember, this would not technically be a default, and it would
allow
allow you to start your economy with essentially no debt, which is probably would help the markets dramatically.
Yeah.
Good morning. A couple of quick questions. First of all, I agree with you, Professor Beveridge, about what a yes vote means is a lot more than currency. On that particular point, what about taxation? Do you think that we could run a more efficient system after a yes vote?
Andrew, you want to take that one?
I can try hard. I mean, that's partly an administrative question, and we discovered in the Finance Committee last week that neither of the two of us have ever run a tax system in detail, so we don't know how the computer does it, as it were. But the answer to your question has to be surely yes. Other countries can do it, and if they can do it, we could do it. There was an OECD report, I've forgotten the year, 2008, thereabouts, which pointed out that per pound of GDP, I think it was Finland and Norway cost something like 60%, per pound of tax taken in, they cost 60% of what HMRC costs in the UK. And so, you know, if I was asked to answer that question in reality, a quick trip over there to say, how do you do it, would pay enormous dividends. It can obviously be done.
I think that, just to repeat a comment that we made to the Finance Committee last week, because they were specifically asking us about the taxation, the Scottish changes to taxation here under the Scotland Act. I think our response to them, which I'm sure Jim Murley's would say as well, is don't just start with tax. Start with the kind of society that you want to build and what it is you're trying to achieve, and then go figure out a tax system that is both effective and efficient to be able to go and get that done. Now, it's very easy to say and probably extraordinarily complicated to do. But I mean, I think that's the right place to start, and you would have an opportunity to do that.
Thanks very much for the answer. My second question is again about currency. It's regarding what happened beginning of the year. We talked about it already in some question when the Treasury decided to come out and saying that they will take the sole responsibility for the debt. They said that it was under pressure from the markets. Do you think that the markets could put the same kind of pressure after I heard your comments on the monetary unions? Maybe we could put the same pressure before the referendum on the, Mr. Osborne to change his mind?
I think it certainly was part of the reason for the Treasury saying this was that there are many holders of government debt out there that are not in the UK, and some in the UK, but a lot outside. And they needed some assurance that there wasn't suddenly going to be a certain proportion of their debt that was moved to somebody that they hadn't ever dealt with in the past, and that the legal liability for that debt would remain with the person who had gotten the debt in the first place. So could the markets look again? I mean, nothing would change. I mean, even if we took on the debt, it would be in the form that the Treasury would still have the responsibility for it, and we would simply have an agreement with them that we would pay a portion of the monies that were due on that debt. It's only when that debt starts to retire and we start to float our own bonds to make money that you would have a different discussion about what the market would want to do with you. But it wouldn't change anything for the liability for the debt, whether we voted yes or no.
Yeah, the point I was trying to make is the markets made the Treasury changing their mind. Maybe the markets could put pressure if they think that, like yourself, that monetary union will be better for both sides to change their mind before the referendum on this as well.
I think it's unlikely, Andrew, do you?
No, the markets might say something like they preferred Plan A. Well, they would, because it will be more stable and lead to a better economic performance both sides of the border. So, they quite like that. The thing that, as far as debt and these other problems are concerned, that worry the market more than anything else, and you can see it in the Standard & Poor's report, is that the thing they really worry about is growth, or possibly the lack of it. And since you would expect to get more growth out of that monetary arrangement simply because it's cooperative, and people trying to get the best for both parties out of it, they would probably prefer that. So there might be some implicit pressure, but this is not going to be a pressure which you can see in an indicator very easily.
Thanks very much for your answer.
Just to follow up, surely if there was going to be an adverse market reaction, we would have seen that immediately after George Osborne's speech. Yeah.
Right.
Yeah. Okay. If there are no more questions, I think we're out of time. Thank you very much to you both. That's been extremely helpful to the committee. And we'll now suspend for a few minutes to allow a changeover. Right, okay, if we can reconvene, welcome our third panel. We have Professor Charlie Jeffrey, Professor of Politics at the University of Edinburgh and Director of the ESRC programme on the future of the UK and Scotland, Professor David Simpson, economist and author, Professor David Bell, University of Stirling, and Fellow of the ESRC programme. Welcome to you all. I think in view of the time, I won't ask you to make opening statements, we'll just go into questions. And I would ask members if they would keep their questions short and to the point, and answers short and to the point would be very helpful. And I would ask people if they would please direct their questions to a particular panel member rather than just open. But if you want to answer a question that's been directed to somebody else, it would just catch my eye and I'll bring you in as time allows. And we'll hope to finish by 1 o'clock. Can I maybe just start on the currency issue, which I think has dominated the previous two sessions? I think some of you may have seen some of the exchanges. I'll maybe ask you both just quickly to comment on this issue. We heard it said in the first panel by Dr. Armstrong and others that a monetary union with the rest of the UK was not in the rest of the UK's interests, and therefore the stance being taken by George Osborne and his counterparts was a rational one. I also quoted comments from Professor Paul Krugman expressing concern about that model. And the Fiscal Commission, of course, defended their position, and Crawford Beveridge, the chair, just told us that, if I quoted correctly, the approach being taken was just spite. Where do you stand on this? Is it a rational position to take for the rest of the UK to say there should not be a currency union? Professor Jeffrey.
Thank you very much. I'm going to take a rather different perspective in answering that question than my colleagues might. I'm a political scientist, not an economist. And I do think in exploring how the two sides in the debate and the two governments are presenting the issue, it's important to understand what they both mean by independence. And I think the word means different things to both governments. The Scottish Government's vision of independence is one which has strong continuing relationships with the rest of the UK in all sorts of fields, and currency union is the most prominent. And the UK government's conception of independence, which we see, I think, in parallel in thinking about the European Union and the UK's relationship with the EU, but also internally in the Scottish debate, is one in which, I use the terminology real, or you might say classical independence, is one in which states run their own currencies and do all sorts of things on their own, which the Scottish Government envisages being done in continuing collaboration. And I think understanding those different starting points is really important in understanding where we are in that debate at the moment. So it may not be so much a question of interest, but more one of more fundamental understandings or philosophies of statehood.
Okay, thank you. Professor Simpson.
I'd just like to say two things in answer to your question, Chairman. First of all, it seems to me that the arrangement proposed by the Merleys Commission represents continuity and not much change, really, just carrying on as we are. And we all know how much businesses dislike uncertainty, and therefore continuity represents certainty. So I think that's the first thing I would say in favour of monetary union. And the second thing is, I would say, is that every year the landscape of financial regulation is changing, and cross-border cooperation becomes ever more prominent. And indeed, in the latest example, the UK government is discussing supervision of banks with the US government, with a view to there being shortly some formal degree of cooperation. So in that context, it seems a little strange to hear that the UK government is unwilling to envisage cross-border cooperation with an independent Scotland.
Okay. Professor Bell.
Yes, let me answer it slightly from an angle as well. Last weekend, my son introduced my wife and I to the Myers-Briggs test, which is a way of deciding how your character is balanced, and I came out as cold and unemotional. Now, I have spoken to a number of audiences in relation to Mr. Osborne's discussion on whether a currency union would be acceptable or not, and I have seen a variety of emotional responses, which, as a kind of cold-blooded economist with an interest in game theory, I found quite difficult to empathise with. So, I mean, I look at it in a kind of cold-hearted way, and clearly there is an argument on transactions costs that there is a case for continuing a currency union. It's just, that's one side of the story. The other side are concerns what risks might be associated, and the risks will lie with the larger of the two partners, because it won't be the case ever that Scotland should bail out the rest of the UK. So, as David was talking about, banking poses a risk, the liquidity of the banking system, so you would have to have pretty much a banking union, it seemed to me. But then there's the issue on the fiscal side, where an optimal currency area is defined effectively where there are fiscal transfers. So if a shock, like an oil price collapse, hits Scotland, how does that? How does the UK government deal with that at the minute? Well, it makes transfers, taxes fall in Aberdeen, unemployment benefit rises, and so on. Post-independence, there wouldn't be these fiscal transfers. So the issue then becomes, what would be the nature of the agreement that the our UK government and the Scottish government would have to make around the currency union, and could that be a binding agreement? And what kind of commitment could be made that would be credible in our UK's view by the Scottish government? So I think that is an absolutely critical issue, because we've seen such agreements made in good faith round a table like this disintegrate in the debt markets. So I guess I'm not saying it couldn't happen, but I can see from the perspective of our UK government that there could potentially be a fairly significant downside.
Okay. I'll bring you in a second. I just want to ask one follow-up question related to this currency issue, which I put to the previous panel. Are any of you aware of a model, a historical model, where there's been a dissolution of a political union and a successful monetary union put in place?
I'm not aware of that, but then I'm not a historian. So I don't know that fact of the dissolution is necessarily a relevant factor. I think much more importantly is whether the structures of the economies are similar and whether there's significant labour mobility between them. That's usually the traditional idea of whether monetary union is likely to be successful. And of course, as David indicated, you have to have agreed rules of the game and be confident that people will stick to them. But I would be astonished that in a two-country monetary union like ourselves in England, you would have a problem of, shall we say, bad faith, which has happened in the case of a 17-country organisation like the Monetary Union, where governments make blithe promises, fairly secure in the knowledge that they won't be held to them. I don't think that would arise in negotiations between Scotland and
Okay. Professor Bell?
Quite apart, I mean, for the obvious reason, it's not because we're particularly virtuous, but because there would be countervailing sanctions.
I am encouraged by your faith in the good honesty of politicians. Professor Bell?
I don't know of any historical example. Of course, the one that's quoted a lot is the Czech-Slovak one, where there was a loose commitment, I think, to go to separate currencies after a period of time. I think it was 6 months or so. But the markets, of course, anticipated that and caused the breakdown of the currency union within a matter of weeks. So I guess another point that is worth making is that if you look at the way in which the Scottish and UK economies have behaved since about the mid-1980s, probably Scotland has tracked the UK as a whole better than any other part of the UK. Now, you would say that in David's terms, that means that we have the same cycle, so we wouldn't be subject to differential shocks. So there wouldn't be a particular disaster in Scotland which didn't wasn't the same sort of event in the rest of the UK. There is, however, the point that's made by Professor MacDonald of Glasgow University that although in essence we've had the same cycles, Scotland would be more exposed to oil price shocks than the rest of the UK ever has been, because it's a much larger part of the UK. Sorry, of the Scottish economy than of the UK economy. And we can see with the recent discussion, I think the Institute, partly the Institute of Fiscal Studies stuff yesterday, and partly the modelling that was done in the white paper shows radically different perspectives of what oil revenues would be by around £4 or £5 billion in about 2 or 3 years' time. That's a big gap when your total spend is about 60 billion. It's 1/15, 7%, 6-7% of your total public spending could go on. What at the moment is a difference of opinion, but then could actually be reflected if the price did jump about.
Okay, I'll bring Chick Brodie in for a quick supplementary.
Thank you. It seems in most of the discussions we have, the financial sword of Damocles seems to hang over Scotland in terms of its oil collapse. But of course, we know that 5-6 years ago, it was the financial sector, the banks that effectively collapsed. I wonder if you can help me with, I'm not sure whether it's a myth or not, but when we talk about, as we still apparently talk about bank bailouts, notwithstanding the regulations that are supposed to be being applied through Vickers. I wonder if, and Professor Simpson gave us an excellent paper, just exactly who owns the assets and the liabilities of the banks? We talk about Scottish banks, but effectively they're not, are they?
No, they're not. I don't know the answer to your question. I don't know who owns the...
nominally, in terms of the assets and liabilities, do they not fall in the country in which they operate?
Yeah, I mean, nominally, obviously, the shareholders are responsible for both the assets and the liabilities. As far as, I think, I said a moment ago that the landscape of financial regulation is changing, and one of the important aspects of this relates to the shift from bailout to bail-in. When the Royal Bank collapsed in 2008, then there was no alternative but for the taxpayer to pick up the tab, because the UK government did not have in place what they call a resolution mechanism for dealing with the failing banks. Such a mechanism is now being put in place, and not only in UK but in Europe as well. So in the future, there should not be claim on the taxpayer to such an either to no extent or to such an extent, but much more importantly, the purpose of these bail-ins is to give the owners, that's the shareholders, and the creditors and the management, an incentive to behave prudently. Whereas in the run-up to the 2008 crisis, all the incentives were the other way. All the directors of all the big banks had an incentive to behave as recklessly as possible because they knew that if they were successful, they would make a lot of money for their shareholders, and if they failed, somebody else would bail them out, which is in fact what happened.
The ownership of the banks, of course, there are a couple that are in large part owned by us, but the shareholding will be spread possibly worldwide. Pension funds will hold a large chunk of that. It is important, I think, just in general, I suspect this is a lesson I learned from David Simpson some time ago. It is important to think of the head office, the ownership of a company, the operations, and the shareholders possibly being located in different places. There's no reason why they need all be coincident. We do have major operations or major employers within Scotland that are in the financial services sector where the headquarters and the responsibility for financial management lies outside Scotland. Not a retail bank, but other kinds of operation.
I think that clarifies, but what do I try and move the debate away necessarily from the oil collapse and the impact on the Scottish economy and any potential bailout, although, as I said, I would hope that we never face that again, of the banks, which, the majority of which operate out of London, but not internationally as well. Can I have one question for Professor Jeffrey? I just wonder, in terms of the debate, taking that debate on, it's wider than, clearly it's very important for Scots and Scottish independence and what that means in terms of the rest of the UK and indeed Europe and globally. Are you disappointed as a political economist that the opposition parties have been unable to make any genuine guaranteed offer to the people of Scotland in the event of a no vote with more powers? In fact, the leader of the Conservatives in Scotland has stated that there will be no agreement before the referendum between the three anti-independence parties. Do you think that's shortchanging the Scottish people?
I certainly wouldn't say I'm disappointed, because I don't think it's my place to personally offer my approval or disappointment for those parties. Clearly, the Liberal Democrats have set out a proposition for what they call home rule, but certainly is an extended form of devolution, and the other two main parties in Scotland are considering this, and we should hear from the Labour Party in a couple of weeks' time. I'll move away from the terrain of disappointment and towards the terrain of tactical logics, which I put in the paper, and draw attention to this mythical median voter in Scotland. That is that voter who stands right at the middle of the spectrum of opinion and whose support needs to be won in order to create a majority. And it's pretty clear that the median voter in Scotland is somebody who is in the Devo Max, or at least Devo more than now category. And in that sense, I can see a strong tactical logic for the Liberal Democrats, Labour and the Conservatives to have an offer in place. Whether that offer comes, we shall see. Whether it's coordinated, we shall see. I think the two parties which have not yet published are having robust internal debates at the moment, and we look forward to seeing how they turn out.
Of course, we know there will be no agreement between them before the referendum, but I'll leave it there. Thank you.
Thank you. Alison Johnson wants a quick supplementary.
Yeah, just a quick supplementary on Chick Brodie's first question. And I think, Professor Simpson, perhaps you could elaborate. If we are seeing a sort of a shift away from the idea of bailouts to bailouts by the taxpayer to bail-ins by the management, shareholders and creditors, why is this who's going to bail us out in the case of a disaster argument being used as an argument for remaining with the status quo?
Well, I think that I think people haven't really grasped the fact. The people that are much of the discussion has not grasped the fact that there is this movement from bailout to bail-in, and I think that once that has sunk into people, I think it will maybe begin to be realised that the whole question of lender of last resort is another, smokescreen is the wrong word, but there's a misapprehension about it, because until 2007, lender of last resort meant that the central bank, in our case the Bank of England, would be willing to lend money temporarily, liquidity is the jargon, to solvent banks, and I emphasize solvent banks, which had good collateral. Now that has completely got lost, that principle of lender of last resort, and instead of that, or more to the front, has come the idea of lending to banks that are not solvent, that are bust, and may not have good collateral or no collateral at all. And that has been the big problem that all governments have been wrestling with for the last 3 or 4 or 5 years. And I think the only answer to that question is that partly that the movement to a bail-in, as I said earlier, will change the incentives of bank directors. But also I think you have to have much more intrusive regulation, because I'm sure everybody's familiar with the anecdotes of just what went on in the banks in the run-up to the collapse. And that should never have been allowed to happen. I worked for an insurance company for a while, a life insurance company, and I don't think I can remember having heard of a collapse of a life insurance company. One of the reasons for that, I believe, is because every year they had to publish the most intrusive details of their transactions, which were not just for the Department of Industry, but for everyone to see, so that everybody knew what was going on. And I think that's maybe that sort of kind of regulation is what we need in retail banking as well.
Thank you. Thank you,
Policyholder with Equitable Life, you've touched on a very sore point, I have to say.
Well, let me tell you that Equitable Life did not go insolvent, at least I believe I'm right in saying that. What happened was that the expectations of some of the policyholders were disappointing.
I think that's a very fair assessment.
However, I think that the blame of that should be attributed to the House of Lords, who came up with this very bizarre judgment.
And the religious support as well.
Yes. Thank you. Okay, Joan McAlpin.
Thank you very much, Convener. I've just got one question for each panellist. If I could start with Professor Jeffrey first. You talked about more powers and the possibility of the other parties agreeing a package before the referendum. I have to say you didn't sound terribly optimistic that they would, but hypothetically, if more powers were on the table, one of the arguments is that this would open up the door to an end of the Barnett formula. Do you see the Barnett formula lasting if there's a no vote?
Okay, I can't foresee that far ahead. The example of the provisions of the Scotland Act 2012 widening the fiscal autonomy of the Scottish Parliament around income tax had an implication for the extent of the block grant. The block grant would be reduced by the value of the 10% reduction in income tax, and then it would be up to the Scottish Parliament to decide the final level. Clearly there would be, if there were further adjustments, as has been suggested by the Campbell Commission, also the Devo Plus Group, the IPPR and its Devo More, and as signalled in the Labour Commission's interim report, you would imagine that there would be a further consequent adjustment of the way that the Barnett formula operates. I have seen in none of those discussions so far, and I can't say I am privy to the Labour Party's Commission's discussions or to the Conservatives, a commitment more fundamentally to remove the block element which the Barnett formula describes. So as far as I can foresee, from the information available, the answer would appear to be unlikely.
From Professor Armstrong's comments this morning, there just seemed to be a suggestion that there would be an adjustment, was her term, in Barnett, and that would move towards a more needs-based formula. And one example we have is Holtham, which would result in a £4 billion cut to Scotland's budget. Is that something that would concern you?
There will remain potential to renegotiate funding arrangements if the constitutional relationships within the UK continue to evolve. The Holtham Commission produced a set of calculations which would indeed be challenging in the Scottish case if a systematic needs-based approach were applied across the UK. I'd have to say we have not had a systematic needs-based approach in the past, so that would be a significant breach with tradition in a state which tends to follow its traditions and adhere to them quite stickily. So I wasn't here to hear what Dr. Armstrong said, but that would be my perspective on those comments.
Thank you very much. If I could move on to Professor Simpson. Professor Simpson, you're a former chief economist at Standard Life. I wondered if you could reflect on the recent furore over Standard Life in the media and whether you think it's been misreported or not.
I think that there is a legitimate concern for life companies and banks who are registered or headquartered in Scotland and most of whose customers are in England. And they would want to be reassured that after independence, the people in both jurisdictions would not be disadvantaged with respect to whatever offers their competing companies could make to them. And that's one of the reasons why the proposal by Merlis and his colleagues is a good one, because it reassures these companies on the score, essentially, of tax questions and regulatory questions. And so it should make it possible for business as usual to be continued. Now, leaving that aside and coming to the question of the announcement, I must confess that I am slightly suspicious about the timing, not the substance of the concerns, because, as I say, there are legitimate concerns. Slightly suspicious about the timing of it, but more importantly, it seems to me that the uncertainty which is being created is something which can really only be resolved by the government in London, not by the government up here, because the government up here put their cards on the table and say, this is what we propose to do, and if this is accepted, then these problems will be resolved. It's up to the government in London, I think, to respond by at least discussing the offer that's on the table, and to the extent that they don't discuss it, to that extent uncertainty is heightened, and that can only be damaging for financial businesses which are registered in Scotland.
So what you're saying is that it was the political statement by the Chancellor that's increasing the uncertainty for businesses?
Well, the fact that he effectively declined. One of the things that's, if you follow the literature and all this, which is fairly boring for everyone who's not an economist, economists tend to like boring stuff, is that you'll remember that the Fiscal Commission produced its report about a year ago, And that was extremely detailed in great depth about all the issues that have been subsequently talked about. Yet neither Mark Carney in his speech in Edinburgh 6 weeks ago, nor George Osborne 2 weeks ago, referred to the report of Merrilies, despite the fact that they were addressing exactly the same issues. And in the Treasury document that came along with George Osborne's speech, there's a long bibliography which completely omits any mention of Merrilies' proposals. Now that to me is a sign that this is political rather than an economic discussion.
This morning, Crawford Beveridge from the Commission revealed to the committee that the HM Treasury had not entered into any discussions with the Commission, despite the Commission's best efforts, and he contrasted that to Bank of England officials who were willing to engage. That would seem to back up what you're saying, that there's a political agenda at work here.
I'm afraid that's very obviously the case. Yeah.
Okay, you've had 5 questions, President McAlpin. You finished? Okay, thank you. Margaret McDougall.
Thank you, and good afternoon, panel. Can I just ask a question around the currency to Professor Simpson? When you have said that an informal currency union is an attractive and feasible option because it delivers the main benefits without some of the costs, could you perhaps tell us what the costs are that an informal currency avoids?
It avoids, yes, it avoids all the costs in which you have to, if you enter into monetary union with an associated banking union, you have to agree with the other partner limitations on both your activities, budget restrictions, restrictions on regulation and what have you, which might be irksome to you. Whereas if you just go it alone, as it were, then you're free to take your own decisions. Now, some of these might prove to be imprudent, and some of them might be more prudent, but at least you do it. You're not trammeled or constrained by external agreements. That's what I had in mind.
What would be the risks associated with that?
Well, I think that the risks are, most people would see the risks as being the absence of a lender of last resort. But as I said in my paper, the historical evidence is that that actually is an incentive for good behavior. Now, I come back to the example of Ireland, which is the simplest one, because Ireland in 1922 is in very much the same position in many respects as to Scotland is now. It left the United Kingdom, continued to use sterling, did not depend on any lender of last resort, and yet it had no banking problems right up to when it left that position in 1979. It still had no banking problems until it joined the euro in 2002. So I think that is what I would see as being a classic example of how not having a lender of last resort actually encourages good behaviour on the part of banks.
Professor Bell is shaking his head vigorously at that.
I don't think it's true that Ireland had no problems. It did have some problems, and there's an excellent paper written by my classmate Patrick Honohan, who is now the head of the Central Bank in Ireland, on the history of the Irish monetary circumstances.
Thank you for that. Could I just continue, excuse me, with a question to Professor Bell on debt and what would happen around debt. So if Scotland did not take on its share of the debt and its credit rating plummeted, what would be the effect to the economy in Scotland?
Well, it is UK debt. It's not Scottish debt. That's the first thing to say. And the UK has agreed that it will pay back that debt. So the question is whether Scotland would offer to service that debt. And my understanding is that that kind of offer is on the table. So you take a population share, and you make the interest payments on that. What will happen is, though, that each year a certain proportion of that debt will mature, and you have to then try to roll it over in the markets if you're going to continue to fund your public services. Key question is whether you pay a higher rate of interest or whether you pay the same rate of interest or a lower rate of interest. And there has been, I think, earlier today, some debate about what that rate of interest might be. And Dr. Armstrong has done some extensive research on this in relation to the bond yields of different countries in the euro area. And they depend on things like debt to GDP ratio. But there's one thing that is kind of difficult for Scotland to avoid, and that's liquidity risk associated with bonds. So it's really the question of whether you can find, if you're trying to sell, a buyer, or if you're trying to buy a seller of Scottish bonds. And if the market is smaller, which it undoubtedly would be, that becomes a little more difficult to do, and you build in a premium based on that. In fact, the discussion about differences in interest rates on a potential Scottish bonds hinges a lot on that particular issue.
So it would be the interest rates are likely to be higher than for in Scotland if we were looking to the markets.
Well,
as
it would depend. It would depend on other circumstances, but the liquidity risk is unavoidable because Scotland is smaller.
I just check on that while liquidity is one of the factors, there are other factors that would come into it. And for example, Switzerland, Denmark, Finland, all comparable sizes or thereabouts to Scotland, have lower interest rates at the moment on 10-year bonds than the UK does.
They have much lower debt. I mean, so having a low debt is clearly one of another part of the story. That's absolutely true. The question that we really can't answer is how the markets would react to Scotland if it was felt to be the case that it ought to have taken on a share of the debt and it decided not to.
I would just, if I may, Chairman, add the fact that one of the many factors that enter into this, which we haven't mentioned, but which I think the markets would look at very keenly, is the prudence or otherwise of the budgetary policies of the government, whether it be Scotland or anyone else. So markets are much more willing to lend at more favourable rates if they thought the government was doing its best to get its finances in order. I think that's one of the key factors.
I completely agree with that point.
Okay, brief follow-up, Chick.
Just this, I apologise for quoting what I've already quoted twice today, which is the Standard & Poor's credit rating. It says that Scotland would qualify for the highest economic assessment, and Scottish wealth levels are comparable to that of, and again I quote, Germany. If we don't accept any of the debt, if Mr Osborne continues with his nonsense, if we don't accept any of the debt, then Scotland's in a fairly advantageous place, isn't it, in terms of borrowing?
Yeah, I'm not quite sure if that was a question or not.
Do you agree or disagree?
Well, I'm afraid I didn't. To be honest, I'm slightly hard of hearing. So could you be kind enough to repeat the question?
Basically, I was quoting the Standard & Poor's rating. This rating is direct, which says Scotland would qualify for their highest economic assessment. And the Scottish wealth levels are comparable, for example, to Germany. So if on the basis that we start with no debt, I think Dr Armstrong actually made the point today, then our borrowing capability should be quite reasonable, probably at lower interest rates than elsewhere.
Yeah, well, I've read the Standard & Poor assessment, and I've no reason to deviate from it. Maybe at the risk of being slightly provocative, however, I would be, if I were in a negotiating position, which fortunately I won't be, I would be disinclined to automatically take on any share of the UK debt unless there was some quid pro quo on the other side. I remember, for example, that to come back to the example of Ireland again, that when Ireland left the UK in 1922, it didn't take on any of the UK's national debt in exchange for moving the border some way closer to, or rather further away from Belfast, I think was the terms of it. So I would be prepared, if I were a negotiator, to say that we will be prepared to take, we will not be prepared to take on any share of UK national debt, but we shall give up our claims to Berwick and Carlisle.
That's interesting.
Anybody else want to comment on that point?
I think David hits on an important point, and that is that it is pretty difficult to predict exactly where we might or might not be, because there will be so many things in this mix in relation to the negotiation. It is very difficult to know now where we can point to factors that might influence, say, the interest rates that might pertain to Scottish debt, but we don't know really.
Wilson Johnson.
Well, you were involved in a study looking at inequality in Scotland previously. I just wondered what you believe are the tools that we have at our disposal currently that could be most effectively used to address that inequality, and the tools that we might have in an independent Scotland, and what you would see as the optimal scenario for addressing the inequality we face.
So basically our paper argued that one can fiddle about with the tax and benefits system to some extent, but inequality in Scotland and indeed in the UK as a whole is such that movements in tax and benefits are unlikely to bring levels of inequality down very substantially, and they may have negative incentive effects on employees, employers, and so on. So essentially what it seems to me an independent Scotland would have to think about very carefully is what I call the missing middle, the gap that's opened up between, on the one hand, relatively poorly paid workers who are involved particularly in personalised services that can't be substituted by Chinese labour, on the one hand, and on the other, the very skilled group who are innovating, working in science parks and the financial sector, the oil sector, driving the Scottish economy forward. There's the gap between these two groups has grown, and there's not an obvious ladder from one to the other in the way that there used to be from an apprentice to a semi-skilled to skilled to foreman and then up into management. That sort of thing doesn't exist in the same way that it used to do, and a lot of what the Scottish government would have to think about, it seems to me, is how to get more people of middling level of pay. You could certainly look at the living wage as one part of that, but even the living wage is relatively low wage. But to get the skills and competences and employability of young people in particular up to the kinds of levels where those kinds of jobs, and you'd have to work with industry to do this, where those kinds of jobs formed a bigger part of the economy than they do now.
I appreciate you're saying that the tax system isn't the answer to all of these issues, but going back to the tax system, how quickly could we see, you know, a transition to an independent tax system? Are we looking at 10 years? You know, what would that transition look like?
Well, so bits of it will already be in place in a sense. So actually, the Scottish rate of income tax is an HMRC tax. It's not Scottish in that sense, in that it's been administered by HMRC, whereas the stamp duty land tax and the landfill tax are now being operated by Revenue Scotland. So there is a body there now in existence. It seems to me probably that with goodwill it would be possible to transfer quite a lot of the personal tax stuff relatively quickly. What would be much more complex, I think, would be corporate taxation, and there would be a big issue around oil as well, and how contracts that are currently between oil companies and HMRC would be transferred to contracts between oil companies and the Scottish Government. So I don't think that could be done overnight. I think on the personal side, you could move reasonably swiftly, but there would be processes of negotiation because some of the players on the other side of the fence are pretty big players. So that there would be a process of negotiation in setting that component of the tax system up, it would seem to me.
Just ask one further question.
Yeah.
I'm sort of thinking about your earlier response where you were saying tax isn't the way, you know, we need to ensure that we're properly skilling our young people and so on. Is there more we could be doing now under devolution? And what would you suggest as a first step?
It's actually, I mean, there is a case, it seems to me, for looking at the balance of spending in education generally. I might say something that's quite unpopular and say how much is spent on higher education, for example, and compare that with what's spent on early years, which all of the evidence now seems to be saying is so critical to young people, and also at the interaction between services that the Scottish Government provides and that are also provided through the welfare system, broadly defined like job seekers allowance and so on. And I'm not an expert in this, but it's not obvious to me that that is joined up, coming from two different sources of authority currently.
Thank you. Thank you.
Thank you very much. Okay, I've got 4 members left to ask questions, and we are a little bit short on time, so if we can sharpen up a bit, that would be helpful. Christian Allard.
Yes, thank you, Convener. A question for Professor Jeffrey is regarding what you touched it earlier on to talk about the negotiation between political and other people. But you highlighted the statement from Mark Carney that the bank will implement a currency area if that is what politicians agree. Now, I know you said that you were not surprised by the reaction of the Chancellor and the way negotiation will take place, but it's a difference between the Scottish agenda and maybe the rest of the UK agenda. But Mark Carney, being a Canadian, seems to have a different views how the things will pan out after a yes vote. Do you think that this political stance could survive?
I'm not sure Governor Carney has overt views about the outcome of the referendum and what will follow. I think he was saying that if there were a yes vote and if the two governments were to agree on a currency union, then it would be his job to implement that and to ensure that there were the correct governance arrangements and no doubt to advise on ancillary matters such as the level of fiscal coordination that might be needed. I think he was very careful to place himself in a technocratic position to say that I will do what the political bosses agree should be done. I don't think he was making a statement on a negotiation process following a yes vote.
We're saying that he came up to Scotland and did speak to the Scottish Government things that maybe the politician didn't do?
I don't know what he may have said to the Scottish Government while he was here.
Well, there seems to be a kind of relationship that a political stance that doesn't reflect maybe the reality. If you talk with the governor of the Bank of England, doesn't need to take a political stance and is more interested about solving the issues as opposed to create a conflict.
Yeah, and I think that again was the point less made in his speech and more made in the discussion afterwards, that were politics to come to that conclusion, he would fix it.
Anybody wants to comment?
Thank you. Thank you. Richard Baker.
To ask a question on the same issue, because, I mean, is this stance that's been taken by the Chancellor, the UK Treasury and others really that unreasonable given the experience of recent history? Because we've had a situation, we had, we talked about sharing of risk in the previous session, we had a situation where there was a financial crash and two of the major banks of Britain, headquartered in Scotland, had to be bailed out to the tune of some £467 billion, including underwriting toxic debt. Our First Minister at the time advocated a light touch to financial regulations. There was, unfortunately, a consensus on that as well. So, given that experience, is it really unreasonable for UK ministers and the Treasury itself to be sceptical, at the very least, about that proposition?
I'll offer one or two thoughts on that. Unreasonable or not, that's again a language I don't particularly want to get into. I will say I think there are a number of features in the UK government's position. One is clearly to state that in the event of independence, the UK government will be responsible for the territory of the current UK minus Scotland and will calculate a national interest on that basis. And that may have an interaction with the issues that you just raised. Although I would say we are probably now in a different era of understandings about how to do financial regulation than we were then. I'd also say that the UK political system more generally, Westminster and Whitehall, to give it its shorthand, does have a different understanding of independent statehood, and I think it's projecting that understanding onto a possible future relationship with Scotland. There is a different mindset than that which the Scottish Government represents. And there may well also be a shorter-term tactical element in the way that the Chancellor and the others presented their case in order to help win the referendum from his and their perspective.
I suppose the point I'm making, though, is that this isn't just about politics. Actually, there's a strong economic argument why a small partner in the monetary union can cause a huge burden to the sharing of risk within that currency union. I don't know if any other of the panel members.
That is clearly one of the issues which would be part of that national interest calculation. I did put in my paper the observation that the Eurozone faces enormous tensions with the fundamentals of different members of that Eurozone in a very, very far greater state of divergence than our UK and Scotland would be. Yet there is the political will among the strongest and the weakest for that zone to persist. Now that suggests to me that politics and not economics can be one of the fundamentals in this debate. I offer that simply as an observation about a broadly comparable example, that politics and economics exist in a dynamic relationship with one another, and I think often the politics predominates.
Okay, one final question, and we could come back on Mr. Jeffrey. Professor Jeffrey, I'm not sure that Eurozones are cracking a success or an example. But I mean, I think the final question is to Professor Simpson, because you've previously advocated that if Scotland were to be independent, that would help it address a culture of dependency, and also allow Scotland to do that because to create a more business-friendly environment. Why could these things not be established through a greater devolved settlement, a devolution plus, as Professor Jeffrey referred to earlier, or even Devo Max, if we want to call it?
I think it's, I wouldn't rule out that happening. I think it is a question of restoring confidence, and if a Devo Max settlement were to achieve a cultural change, then clearly that would be, 9/10 of the result. But I don't know whether that will or not. But if I might just come back to your last question, yes, it might seem quite reasonable for someone representing the Treasury to say, look, we don't want to take on the risk that there will be another Royal Bank type collapse with unknown quantity of liabilities for English taxpayers. But as I tried to indicate before, that would be most unlikely to happen. But in any case, the elements of any monetary union that was agreed between an independent Scotland and England would have to include a clear understanding as to what would happen in the event that the burden, some part of the burden of a future insolvent bank in either part of the territory should require an element of taxpayer support. And they would have to include a clear agreement as to how that support would be parcelled out in advance.
Okay.
Mark Bianchi.
Thank you. Membership of the EU is very important to business in Scotland. Professor Jeffrey, you said in your submission that the conclusion of almost all independent expert analysis is that Scottish EU membership would be uninterrupted in the event of a yes vote. In the event of a no vote, how much pressure do you think the UK government is going to come under to hold a referendum on EU membership, and what do you think would be the likeliest outcome of that?
I think there will be very strong pressure from precisely the direction you indicated of businesses expressing concerns about EU membership in the Scottish case, in the UK case as well. I suspect that businesses with an international operation are likely to be rather worried about the prospect of the UK leaving the EU. On the question of how a vote might turn out, I have done with colleagues in Cardiff University a number of public attitude surveys in England which explore, amongst other things, the EU question, which I think reveals a significant distinction of public opinion in England as compared with Scotland and, to a lesser extent, Wales, with a much stronger sense that the EU is a problem in England, a governance problem for the English, than is felt in Scotland and Wales, and with a stronger antipathy towards the European Union than in Scotland in particular, and Wales to an extent. This is not to say that the Scots are wildly enthusiastic about Europe. They're less sceptical and probably a bit more pragmatic. I think there's something which is a little bit more elemental in the English attitude. And in our last survey, asking the referendum question in or out of the EU, which would not be the situation we would face were Mr. Cameron to win again and then renegotiate and put a renegotiated package. We don't know what that package would be. But the clear pattern of opinion in that survey conducted in November 2012 was for the English to vote against, at the same time as contemporary polls were saying that there was a Scottish majority in favour of remaining in and a lesser but still Welsh majority in favour of remaining in. So there are differences in public attitudes on the European question which have a territorial element in the UK.
Could I just ask what would be the economic consequences for Scotland in the event of a so-called Brexit?
Well, I was just thinking about the answer Professor Jeffrey gave you there, and if you substituted the word migration for EU, you would have exactly the same set of answers. So the SRC Centre in Oxford and work that we've done shows pretty much that attitudes against to migration are more negative in England than they are in Scotland. But they're still a bit negative in Scotland. That's not to say people are in favour. And of course, that's one of the key economic drivers that would influence Scotland's economic development. If you look at Scotland, its level of income is relatively high within the UK, yet the proportion of its citizens that are foreign-born is much lower than you would expect. And so the increase in the population, which is welcome and that has occurred in the last decade or so, has pretty much been driven by inward migration, which I wonder what I should say, given the stories that are going round about reports on migration today. I suspect if the analysis had been done in Scotland would show that migration had been a very positive effect, both on the population and on the economy.
And the effect of a Brexit, to use that horrible word again?
Well, it would certainly complicate that issue. It is possible, and Quebec is an example of this, for a part of a state to have its own differentiated migration policy, but that is more tricky than if you're a separate state.
Mike McKenzie.
Thank you, Convener. I would just like to maybe follow up on that theme with Professor Bell, because, you know, in terms of the demographic future of Scotland, the challenges facing us, I'm sure you would agree that Scotland doesn't have many of the tools that you can use to tackle that and boost the working age population. Do you foresee a future where Scotland then is unable to respond to that challenge, that demographic challenge, and therefore things get quite serious in that regard?
The answer here is a bit like the answer to the last question. Scotland does have a demographic challenge in that by 2030 the ratio of people who are of working age, however that's defined by that time, and those over that age will be much higher than it is now, and slightly above that in the rest of the UK. But it's relative in the sense that compared with most of Europe, the demographic challenge will be less extreme than is the case for Scotland and indeed for the UK. And if you look at which countries the OECD think have the best long-term growth prospects, it's actually within Europe, the UK. And the reason for that is that it faces the least extreme demographic challenge, although it is still a challenge. Germany and Italy are the countries that will face the strongest such challenge now. So basically we'll be in a situation where there aren't enough births, and everyone will be trying to attract young people from one country to another country, trying to get them there. So you have to have an attractive economy because young people move to where economies are most vibrant. So that seems to me to be a kind of precondition to solving the to adjusting in a better way to the demographic challenge that certainly Scotland faces.
Okay, thank you very much. My next question would be for Professor Simpson, just different subject. Do you feel that Standard Life's recent announcement, do you think that strengthens the case that would be made for a currency union rather than weakens the case?
Strengthens the case for a monetary union.
Yeah.
Very much so, yes.
Yeah.
Very much so, because, as I said, the monetary union with the associated banking union should provide that uniformity of conditions on both sides of the border for banks and insurance companies. So that's why one of the reasons I'm in favour of it.
Yeah. Thank you. And just my final question, and it's I think an area you touched on in your written evidence, I think, which is very interesting, that the risks associated with Scotland's financial sector, you seem to suggest that these are risks that have kind of been dealt with already through, you know, banking regulation, in terms of those risks being correctly assigned now to shareholders and creditors rather than to the taxpayers at large. Could you just, am I correct in my understanding of that?
I'm not familiar with the detail, but what I do know is that there's a couple of pieces of UK banking legislation. There's the Banking Reform Act of 2010, and a similar one, Title 2013, has introduced the principle that when a bank is in danger of becoming insolvent, then the procedure would be for the initial liabilities to fall on shareholders, creditors and managers rather than on taxpayers. I don't know the extent, and maybe the legislation doesn't specify the extent to which there is a taxpayer backup, and I don't know the answer to that. But in principle, there isn't any reason why one shouldn't move to remove the taxpayer entirely from the equation, so that the banks would all be in the position that when they get, if again a big bank gets into trouble, there is a well-established procedure for orderly liquidation, and the burden of the cost falls on these three categories: management, shareholders, creditors, and the depositors are protected, of course, as they are now, by the guarantee scheme. So that should be the model to which we're all moving, and the European Union and the Americans seem to move in the same direction.
Thank you.
Okay, if nobody's got anything to add, I think we can call it a day. Slightly behind the clock. I think we've done very well. So can I thank the witnesses for their contribution and thank members for their cooperation. We will now go into private session very briefly, so we'll suspend just for a couple of minutes and let the witnesses leave, and then we can get on. Thank you very much.